the Miracle 7 stocks, so I've just been killing it. Can I now, change the asset allocation and maybe go smaller, mid-cap, try to take advantage of increased capital spending, increased economic growth? Can I take my profits in those big names?
Well, I wouldn't take your profits,
okay.
Right? Because
we
really,
okay.
The infrastructure layer of Gen AI is in the early innings here. I would try to look more broadly beyond the Magnificent Seven, those other companies that will contribute to development of the infrastructure layer. We can't have Gen AI and large language models without an infrastructure layer. So we do need a lot of building there. But you're right, they're expensive. They've discounted a lot of good news. And so what we've done is we've leaned into the underperformers, particularly mid-cap, less small-cap, mid-cap, more quality-oriented, less leverage, more exposed to what I call this onshoring of manufacturing theme, CapEx expend, et cetera. So we've leaned into value and mid-cap because they're 40% cheaper than your Magnificent Seven, and they trade at multi-decade discounts versus history and large caps as well. So that's one of the things that we've done more recently.
Maybe just buy the equal-weighted S&P 500.
That's no fun.
I mean,
I got to throw it
if
around.
you think the rest of the stocks are going to catch up to your Magnificent
SPW,
Seven.
right? Just the equal weighted. Okay. All right. So what are some? We had the news today. Moody's kind of dumping on the banks again. It seems like kind of old news. How concerned are you at all with the U.S. banking system, or maybe the global banking system?
Well, I'm sorry. Where was Moody's back in March?
Exactly.
I'm sorry. I mean, months later, we wake up and say the small and regional banks have a bit of their funding costs have risen, and they've got exposure to commercial real estate, $1.5 trillion of that. That remains a risk, right? But we've known that risk since March. That hasn't prevented markets from moving higher. We think this is a multi-year development. In other words, we're not going to crash overnight from commercial real estate, but I do wonder where these rating agencies were back in March, why we're doing the downgrades now.
All right, so that's a way of saying that you're not overly concerned about the U.S. banking system or maybe the regional banks?
Well, it is. Look, banking is hugely important to economic growth, and so, regional banks are, where you go, small and medium-sized businesses, and we do think lending will be more constrained. We've seen that in the SLOOS numbers, Senior Loan Officer Survey, have come down a bit, but we don't think it's enough to slow the economy, certainly into a deep recession, right? Mild recession, slowdown, soft landing, it's all a bit nuanced, but don't forget CapEx spending, which we think will be a surprise
here. That is a takeaway from today. No question about it. You're based in London. How are things in London? Because I'm not going because it's too crowded. The flights are disaster here.
Tourism is on fire. You go down Regent Street, you can't even move. But look, London is, I call, a special child category. It's got lots of issues, from Brexit to higher level of inflation to slower growth to increasing interest rates. God, don't get me started. It also has, a stock market that's very commodity and oil sensitive and bank sensitive. So it's a bit of a special child. Now, in terms of international exposure, we like Europe much more. We're getting exposure to industrial shares, CapEx spend. Luxury still continues to be quite strong. Our positive earnings growth in Europe, despite the fact that economic growth has been pretty muted. So that's been where we've had exposure.
All right, Nancy, thanks so much for coming in. Really appreciate you coming in live into our Bloomberg Interactive Broker studio. What's our takeaway today?
We have to get Nancy back is my takeaway.
My takeaway is we have to get her back, but CapEx. It's all about CapEx.
For sure.
Nancy's a partner, global CIO, head of investment advisory at Alt-E Global, based in London. But again, joining us here in our Bloomberg studios in New York. We appreciate that. Market selling off, S&P off 1%, NASDAQ off 1.3%. Let's head down to Washington, D.C. We'll get world and national news. We'll do that with Amy Morris.
All right, thanks, guys. Getting word Florida Governor Ron DeSantis has replaced his campaign manager with his chief of staff, James Altheimer. Politico is reporting that this is now the third campaign shakeup for DeSantis. Meanwhile, lawyers for Donald Trump are asking the court to reject a protective order to limit public disclosure of evidence that had been requested by special counsel. Bloomberg's Nancy Lyons has more now from Washington.
Attorneys for the former president say the order would violate Donald Trump's First Amendment rights and is too broad. They asked the judge to only place limits on sensitive materials being disclosed. Former federal prosecutor David Weinstein tells Bloomberg Balance of Power it's now up to the judge overseeing the case. Tanya Chutkin.
She'll draw on her practice and procedure on what is traditionally done within her courtroom, within the district, and she will fashion her own order that incorporates much of probably what the government has asked for.
In Washington, Nancy Lyons, Bloomberg Radio.
The campaign for former Vice President Mike Pence says the candidate has reached the required donor threshold. A candidate for president needs 40,000 unique donors to be allowed to take part in the first Republican presidential primary debate that's set for August 23rd. Voters in Ohio are heading to the polls today at a controversial special election regarding state constitutional amendments. Bloomberg's Ed Baxter with that part of the story.
It is Ohio's issue 1, and if it's approved, a 60% supermajority would be required to amend the Constitution. Currently, it's a simple majority. Now, this is a GOP-backed referendum that was called to proceed before an expected vote in November on a proposed amendment that would enshrine abortion rights in Ohio's Constitution. The White House has even chimed in now, saying it strongly opposes any attempts to take away a woman's choice. I'm Ed Baxter, Bloomberg Radio.
Global news 24 hours a day, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Amy Morris. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom. It is Bloomberg Business Flash. The major indexes opened lower today, still lower, extending their declines down over 1%, with the financial stocks tumbling. This comes, of course, after Moody's downgraded the credit rating of several small to mid-sized U.S. banks. All of the 11 major industry groups in the S&P 500 were lower. The biggest drag was coming from the financials. Defensive shares, healthcare, that was one of the best-performing industry groups. Yields lower as risk-off money heads into treasuries. The 10-year, 9 basis points lower, 3.99, just below 4. And as we wait for Thursday's CPI, Rob Waldner at Invesco says price pressures are easing.
The data is starting to come in as we've been anticipating, very disinflationary, and it looks like, certain areas like China and the trade data we got overnight feels more like deflationary, and I think that's what's going on in the bond market.
Right now we have the NASDAQ 100, 207 points lower, a decline of 1.3%. S&P 500 down 48 points, that's 1% lower. The Dow Jones Industrial Average 452 points lower, down 1.3%. So Barbie has brought the name Ken back from extinction. The name Ken peaked in 1960. Since then, the name has been on a steady decline. Actually, according to the Journal, only 49 American babies born last year were named Ken. That's
what?
Ken, not
49?
Ken. That's Ken, not Kenneth.
Okay.
The name Ken, by the way, means handsome or born of fire. So,
well, he sure was in that movie. You didn't see it yet?
Good God, who do you think you're talking to over here?
I mean, you have a daughter. You may have taken your daughter, or I don't know. If you're on Tinder, maybe. But
John swipes.
Ken took over. Well, I don't want to spoil it for you. Should I spoil it? He takes over the Barbie dream house and turns it into his own Mojo Dojo Casa house.
Oh no!
Oh, now
you've ruined it.
Now John and I are rushing to the
which I loved.
Yes.
I'm Team Ken.
You're Team Ken. All right, John Tucker, thank you so much. You stay you. If you don't want to go see Barbie, you don't have to go see Barbie, John. Matt Miller, Paul Sweeney here in the Bloomberg Interactive Broker Studio. Yes, we are streaming live on YouTube. You can go over and check it out. Just search Bloomberg Global News. Let's talk transportation. Let's talk trucks, all that fun stuff. Lee Klaskow joins us. He's sector head, senior analyst, freight transportation and logistics. That's a big title. It's a lot bigger than when I knew him. But he's at Bloomberg Intelligence. He does it all, from the ships to the trucks to the railroads and all that stuff in between. UPS, Lee, United Parcel Service, Big Brown, had some disappointing numbers. My question is, are there disappointing numbers, and their guidance, is it a result of their new Teamsters contract, or is it reflecting economy slowing down? Maybe people aren't getting as many boxes as they used to. What's driving it?
Right. Well, first off, you can call me Ken whenever you want. But, they had actually a...
Born of fire. Lee Klaskow, yeah. Born of fire.
They had actually a pretty decent print on the second quarter, but they did guide down.
Okay.
And we expect the increase in costs from that new labor agreement is going to be maybe $1 in EPS headwind. That's kind of okay. That's how we're thinking about it. Obviously, that's assuming they're not going to be able to mitigate that through productivity gains, pricing, and that is what they're going to do. Management said that probably in the spring they're gonna probably lay out how they're going to get back to 12% margins on their domestic business. And that's something that, we're relatively bullish about, because UPS has shown their ability to really embrace not only technology, but also to go into verticals or businesses that are a lot more profitable, like healthcare or the small to mid-sized shipper.
I heard you on Surveillance this morning talking about this UPS story as well as the Yellow story, and I note that they got emergency funding last night. Did they? 17%.
Nice.
Is that not usury? Yes. Is that not a usury level?
Yeah, I mean, what I know, I don't cover Yellow, but what I know about the deal is that it's just it's debt, so just to finance them while they're trying to sell everything. The government is supposed to be made whole before they're able to get paid on that 17%. So
I mean, what do they have?
Refinance
just selling their trucks and warehouses, right? Because they're not, any customer that was going to use Yellow, as soon as they heard there was going to be a strike, was like, let's find another trucker right now. So
yeah, this is not a restructuring. This
Yeah,
is
yeah.
liquidation. And their trucks are old, their trailers are old. If you see them on the road relative to its peers, you'd be like, that's not a great looking truck. They're very old. They've had issues with that for a long time. They don't own a lot of the facilities that they operate in. They lease a lot of them. But there are going to be some facilities that they could sell and to raise that money to pay back not only the government, but also that new round of financing.
All right, so we'll wrap that up and put it to the side. In terms of UPS, can they not raise prices significantly?
Well, they can.
Yeah.
Let's take a step back. They can raise prices, which will mitigate the inflationary pressures that they're facing. The first year of the new labor contract, there's a big step up in cost for them. So it kind of barbells in the first year and the 5 year in terms of the step up. It's around a 3.3 CAGR in terms of inflationary pressure, and that includes not only the wages that they're getting paid, but also the benefits. So if you look at it through the whole 5 years, it's really not that bad, but the first step up is going to be a big headwind. So, we think that they can go back to earnings growth in 2024.
Matt's wondering what CAGR is, but we'll get back to that later.
I mean,
looking at Matt's.
I mean, this is just one of those phrases that you throw around, and I think it's another thing that I always forget, but it's...
I'll let...
Compounded annual growth rate.
Okay.
Boom. There you go.
Thank
Rich, I'm going
you.
to bring it back up in this next question here.
I think a lot of
which is-
listeners are like, hey, thanks, Matt.
Thanks, Matt.
I didn't know what CAGR was either.
Exactly. One of Matt's favorite functions on the Bloomberg terminal is COMP, comparative returns. So I've put that up for UPS and FedEx. UPS over the last 5 years has compounded annual growth in the stock price 11.75%, a little bit better than the S&P. FedEx only 3.4%. Why has UPS been rewarded more in the stock market versus FedEx? Is it a different model?
Yeah, it really depends on like the time frame you're looking at. Like
Okay.
this year, FedEx has been on fire relative to UPS.
But I like the comp function because it just defaults to 5 years, and I think that's a great time period to look at. So.
And over that 5 year period, UPS started right-sizing their network, selling businesses that maybe didn't make a lot of money, like their less than truckload business, the same business that Yellow was in.
LTL,
less than truckload, and they were a unionized carrier, and they were getting on a good year 100 to 200 basis points in margins. It was just not a great business, so they sold that. They're investing heavily in technology. They are automating their facilities. They're reducing the numbers of uh-ohs or mistakes, like if the wrong shipment goes on the wrong truck, by half. They're doing really just a great job in their investment cycle. And not only that, like I said earlier, they're focusing on more profitable businesses. They're focusing on the healthcare businesses and the small to mid-sized businesses. They had somewhat of an outsider. She was a board member, Carol Tomei. She came in as CEO a couple of years ago. I think it's like 2 years by now. And she's really done an excellent job. People were very, kind of not sure if she was the right person, but she's proved all of her critics wrong, and UPS has really been operating on all cylinders.
But now if their costs are going to go up and they have to raise prices, does this give FedEx a chance to take away more share and do better?
Well, UPS on their call this morning, they called out that about 1.2 million packages per day were diverted because of the potential for the strike. And they said about a third of that went to FedEx, about a third of that went to the U.S. Postal Service, and another third went to the regional carriers that you and I probably don't know the names of, smaller players. And they will probably win back some of that freight. FedEx, some of it might be sticky, but at the end of the day, a shipper will use a particular FedEx or UPS, not just on price, but a lot of it has to do with service. And if they were with UPS before, because of service, they're probably going to go back to UPS.
real quick, where are we in the supply chain? Are we kind of fixed? Do you think just a global supply chain? If I order something,
Is it fixed?
Yeah.
No, because every week it's something new, right?
Okay.
Like it's whether the Canadian West Coast ports just got, that just ended. So there's always something different. The Panama Canal, there's not enough water for ships.
Is that right?
Yeah, they have to operate with less freight on them, and it makes it a lot more expensive then to send the freight through the Panama Canal.
There's a great book I read about the building of the Panama Canal. I forget who wrote it, but it is an awesome book. It's a great story. It makes me, I want to go to the Panama Canal.
When did you
Definitely
read
bucket
that?
list.
I'm going to guess you read that 20 years ago?
No, couple 3 years ago, maybe 4
Well,
years
there's
ago.
a drought there. The lake that fills it up is That's the problem.
All right, 10 seconds. Lee Klaskow, transportation analyst, Bloomberg Intelligence, joins us. This is what they call in the business, Matt, a hard out. So
We're done.
we're done. This is Bloomberg. Let's get some company news right now with Lisa Mateo.
Thank you very much. As you've heard here on Bloomberg Markets, well, UPS says its deal with the Teamsters Union is sitting on the company's revenue for the full year. Bloomberg's Joan Doniger reports.
The deal that avoided a driver strike gave the Teamsters Union historic pay increases. It also did away with a two-tier pay system, lower pay for new hires, that the union had hated. UPS now sees revenue coming in about $4 billion lower than it had estimated. But last quarter's revenue was lower too, down 11% year over year. UPS blames weaker e-commerce demand. Quarterly profits, however, did come in a little higher than predicted.
And shares of UPS right now are down about 1%. Under Armour is dealing with a pileup of merchandise. Bloomberg's Gina Cervetti has more.
Inventories jumped 38% last quarter from the year before. But the CEO said growth in the international and direct-to-consumer business offset a challenging consumer retail environment in North America. Overall revenue came in above what Wall Street was expecting.
And shares of Under Armour right now are down just a fraction. And Walt Disney is taking the power of AI very seriously. The company has created a task force to study artificial intelligence and how they can use it. Now this, as Hollywood writers and actors fight to limit the industry's use of that technology. The sources tell Reuters that the group was started before the strike and that it's looking to develop applications in-house as well as form partnerships with startups. Now, Disney has nearly a dozen job postings for those with AI experience. Shares of Disney right now down just a fraction. Those are the company stories we're following this hour. I'm Lisa Mateo, and this is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, Matt Miller and Paul Sweeney here in the Bloomberg Interactive Broker Studio. Rough day for the markets here. S&P 500 is down 1%. The NASDAQ is off about 1.3%. Yields, they are lower here. We got the 10-year Treasury trading right at 4%. It's off 9 basis points here. We had been as low as 3.98%. Looking at crude oil as well, off just a little bit, off about 0.8%, $81.26 for crude oil. Look at that Bitcoin, up 1%, $29,475 for a token of Bitcoin. We'll keep an eye on that. Right now, let's head down to Washington, D.C. We will get world and national news with Amy Mars.
All right, thank you, Paul. Severe storms paralyzing portions of the eastern U.S. Bloomberg's Steve Rappaport has the latest.
Thousands of flights were canceled or delayed yesterday, and more than 1 million customers lost power as storms moved through the region. The wild weather prompted tornado watches and warnings in 10 states from New York to Tennessee. The Knoxville Utilities Board described damage across its service area as widespread and extensive. News outlets reported the storms toppled trees and power lines in multiple states. The National Weather Service also issued a flash flood warning in Maryland after 4 inches of rain fell in a short time. Steve Rappaport, Bloomberg Radio.
Meanwhile, virtually every city in Florida is breaking records today as temperatures are soaring. Same in Texas. It continues to see triple-digit high temperatures across the state. Demand for electricity has hit a record high, the 8th time this summer, as homes and businesses are cranking that air conditioner. The city of Juneau, Alaska, has also declared a state of emergency because there a glacial dam burst that's caused historic flooding with damage well into the millions. New York City is planning to open a new relief center as it tackles the migrant crisis. Bloomberg's Nancy Lyons has those details.
The center will be located on Randall's Island on fields that have primarily been used for soccer. Tents are already going up to accommodate as many as 2,000 adults seeking asylum. And New York City Mayor Eric Adams says all associated costs will be reimbursed by the state. Some 57,000 migrants are in the care of the city, and Adams says 2 more relief centers will open in the coming weeks. Nancy Lyons, Bloomberg Radio.
Many Los Angeles city services are impacted by a one-day strike today. As many as 11,000 city employees are protesting what they call the city's refusal to bargain in good faith. The strike is affecting things like trash pickup, access to public swimming pools, even routine services at LAX. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Amy Morris, and this is Bloomberg. Paul and Matt.
Hey, Amy Morris, thank you so much. We appreciate it. Matt, what do you know about semiconductors, superconductors?
No, superconductors. So I don't know very much at all. In fact, Eric Balchunas pointed this news out to me yesterday that everybody's excited about this superconductor material. John probably knows more about it.
A superconductor, you can conduct electricity with 0 resistance, but you have to do it at super duper cooled temperatures.
Like absolute zero,
under
right?
Intense pressure. It takes a lot of energy to do that. The thing is, if you didn't have to do that and you had a superconductor, electricity, there'd be no loss.
If you didn't have to bring it down to like negative 470 Fahrenheit, which is, I think,
close to absolute zero, which is in Kelvin. But if you didn't have to do that, you could save bundles of money, bundles of electricity. It would be a game changer.
All right,
It's the holy grail in material science.
Well, here's the story. The University of Maryland's Condensed Matter Theory Center challenged claims made by the Seoul-based Quantum Energy Research Center that it had synthesized a material capable of conducting electricity with 0 resistance at room temperature and ambient pressure, known as LK99. The Koreans said that they can do it. University of Maryland said, I don't think so.
Well, the Koreans basically put out some papers that hadn't yet been peer-reviewed. And the Condensed Matter Theory Center at the University of Maryland said in a tweet, okay, this is bogus. But now they've said it's not just bogus. Where's the quote? The theoretical background in the superconductor discussions in these papers are so naive that if it were an undergraduate project at Maryland, we would give it an F.
Oof.
That's what they said.
That's like academics, bare bones, just back and forth. Yes. I mean, these scientists. All right, we'll stay on top of this story. Supercomputers, you never know what you're going to get on Bloomberg Markets. This is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
We got a lot of green on the screen here, but the volume is light.
We constantly underestimate the strength of the U.S. consumer.
This is a market that's much more optimistic or bullish than maybe the central bankers are.
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
The supply chain has still got dislocations globally and here in the U.S.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, coming up in this hour, we're going to check in with Chris Whalen. He's the chairman of the Whalen Global Advisors. He's probably one of the most outspoken voices on the banking space. We want to get his thoughts on Moody's credit downgrade for U.S. banks. Nancy Tengler, she's the CEO and CIO of Laffer Tengler Investments. Will get her call on the markets. Plus, she's got a new ETF out, so that'll be interesting. Plus, Margie Patel, senior portfolio manager at Allspring Global Investments. We love checking in with Margie. She's got great views on these markets, so we'll get her thoughts right here as we prepare for another rate decision coming up. First, John Tucker's got a Bloomberg Business Flash. John, what do you got?
All right, 10 of the 11 major industry groups in the S&P 500 lower. Lone group in the green, defensive, healthcare, financials among the biggest drags. That comes after the downgrade of 10 small and mid-sized lenders by Moody's. All 24 companies in the KBW Bank Index, they are retreating. Dean Kernett, meantime, at Macro Risk Advisors, says investors should stick to tried and true strategies.
Yeah, look, I think at the end of the day, stocks do well in the long run. And what you're trying to do is just keep yourself exposed to risk, in a broad, diversified way.
United Parcel Service dropping on a bearish forecast. Microsoft, Amazon helping lead losses in the NASDAQ 100 right now. The NASDAQ 100, 253 points lower, a decline of 1.7%. The S&P 500, 51 points lower. That's down 1.2%. The Dow Jones Industrial Average, 412 points lower. From Dow Jones, thanks to social media and Google Maps, homes that are even moderately well-known can now be inundated with tourists. Take Lower Manhattan, for instance. Case in point, Cornelia Street. This is a side street in the West Village. You have tourists showing up daily to take pictures of the brick house there. She doesn't own it, but Taylor Swift rented the house in 2016 and immortalized it in the song Cornelia Street.
Well, I see tours looking for Sex and the City locations. I see
That's
tours
not too far. That's 66 Perry Street.
Okay, thank you. And I see tours like for Seinfeld stuff.
Oh, yeah.
Upper West.
Oh, yeah. A buddy of mine lives in Elaine's building.
Is that right?
Yeah. Which I get excited whenever I get to go over to his house because I'm going to Elaine's building.
Tom's Diner, a song as well.
Well, of course, when I went in London, great tour was like rock and roll people's houses, Jimmy Page.
Well, what about
Paul
here, the
McCartney.
Chelsea Hotel, where Sid killed Nancy, and a lot of other things happened down there.
That would be Sid Vicious for
Sid
the younger
Vicious.
crowd.
Yes.
When I was a kid, everybody was excited about the Chelsea Hotel because of that and a number of other things, right? Like Hendrix stayed there and stuff. It's all been revamped and gentrified now, so.
But we digress.
We digress. All right, John Tucker, thank you so much. Matt Miller, Paul Sweeney here in the Bloomberg Interactive Broker Studio. We're streaming on that YouTube thing. Just head over to YouTube and search Bloomberg Global News, and that'll bring it to you. Jess Menton joins us. She's a markets correspondent. A lot of red on the screen here. Jess, I'm not sure what you got for us.
Well, I wanted to bring up Dish because I know in your heyday as a sell-side analyst, obviously, that's sort of in your forte of companies that you were looking at. But this is ticker symbol DISH. It's actually up close to 9%, so it's on pace for its best day since late July. But if you see what's happening here, it's set to buy EchoStar. So obviously, Charlie Ergen, his TV empire really shifting to wireless here. But he was one of these who, really trying to reunite these two, and was actually started EchoStar by selling these satellite dishes in the back of a truck in 1980, and so obviously come a long way since then. But when you look at that stock, it's been on a wild ride. So even though It's up today. Obviously, if you put more into context what's happened on a yearly basis, that stock's down more than 40%.
It's just been, I mean, go put it on a long-term chart because this thing's been public forever. He was an absolute leader in the telecommunications business, one of the first people to shoot some satellites up into orbit and to bring you dish television. That was a phenomenal business for a long time, and he didn't get out when he should have. DirecTV sold to AT&T. He stayed. He said, I'm going to reinvent this business, so he bought a bunch of wireless spectrum. Why? We don't know. We assumed that he was going to be a great poker player like he is. He's a famed poker player, that he would take that spectrum, sell it at a profit, and that would be it. He chose not to. He chose to build a network. Do we need another wireless network in this country?
No.
Probably not. And oh, by the way, it's expensive to build those things.
It definitely
is. Here we are. And he's just kind of taking these two failing companies, putting them together and hoping something finds some magic here. But there were people, legions of investors around the world that would follow Charlie Ergen and go wherever he went, much like John Malone.
I love it when people put two failing companies together.
Yep.
At one point, Deutsche Bank and Commerzbank were talking about a merger, and a German politician famously said, two drunk people shouldn't hold each other up. By the way, that's not the only M&A deal that covers companies you used to work on, right? Because we saw KKR take over Simon & Schuster.
Yeah, and that was $1.6 billion.
Yeah.
You know what? For private equity, that is a great buyer because KKR has a history of owning media. They respect the creative process, creators, things like that. They're not going to go in there and just tear this thing apart, which you often are concerned about when a private equity buys you. So if you're Paramount, it's not non-core asset, sell it. I'm surprised they didn't get more money for it. I could have gotten more back in the day, but here we are. That's the value of publishing these days.
And speaking of Paramount, I mean, seeing that stock rising on obviously the streaming growth that we saw now, but then it also puts pressure on Disney. We will hear from Disney after the bell tomorrow with their results. But looking at Bloomberg Intelligence data, they're really thinking about how, when you're looking more specifically on how their content costs could be basically the highest in the industry when you're looking at Disney, around $30 billion. And so then also the entertainment programming, potentially, this could be an AI play here as far as trimming down production budgets. But the issue there is obviously we see what's going on, especially in Hollywood with the strikes. And that's not something that they would definitely like when you're thinking about what that would mean for jobs. So that's a big thing to look ahead to for tomorrow after the bell. But then also looking at Fox, I mean, those shares up, FOX, this morning as well, but that also was tied to, especially on the digital ad side and the growth that we're seeing in that particular corner of the market.
Yeah, it's tough. It's going to be a tough road. Well, it has been over the last couple of years for these stocks, and I think it's going to continue to be a tough road as they try to figure out how to kind of make money at that street.
Eli Lilly's up 18%.
Isn't that amazing?
It is, and especially when you're looking at what happened with Novo Nordisk, especially a Danish pharmaceutical company. So those shares really jumped on this obesity trial that did exceed estimates. So you're seeing shares like Eli Lilly, which also obviously had their earnings beat expectations, up a lot too. But then you're also seeing shares like Weight Watchers, or formerly known as Weight Watchers, but WW, and those stocks taking off as well that are tied into that type of
because
space.
their new business model is just to be a distributor of these fat shots.
Right.
By the way, who has it? So who has, Novo Nordisk has the Wegovy, right?
Yes.
And then does Eli Lilly have the Ozempic?
Yes, so that's where they have both of those. And so really when you're looking at those companies that are tied to having those drugs, that's what's really seeing a lift here. So taking a look at some of these stocks over here, especially when you're looking at Eli Lilly, and actually if you're looking at what's happening with WW, I mean, those shares for WW, that's up 20%, so on pace for its best day since May. And if you're looking at Lilly, ticker symbol LLY, that's up 17%. So that would put it on pace for its best percentage gain potentially ever here, if that could actually hold through the close there. And then Novo Nordisk, that's up about 17% as well. So that would be at the close, if that holds, its best day since August of 2002. So you're seeing huge moves there, which obviously if you're looking at what's happening in the healthcare space today too, getting a big lift there from these stocks.
We got to get a BI guy, and because I'm wrong to call it a fat shot. I think it's like an appetite suppressant shot.
Right.
So it's not like it melts away fat. It just makes you want, what I'm hoping is it makes you want less or fewer sugary foods.
All right, well, guess what we're going to do at 12:23 p.m. Wall Street time? We're going to talk to Mikey Shaw, smart investor at Bloomberg Intelligence. He covers all these big pharma companies. So he's going to join us, and we'll get all the color there.
Awesome. Because, I mean, that thing, that's just like a game changer for America.
Oh, America in particular.
Not only do you lose the weight, but it decreases your chance of maybe decreases your chance of stroke and heart attack. These are concerns for a lot of people.
All right. And that's, I mean, Lilly is
By the
a
way,
huge company.
Jess, VIX 18, first time we've hit it since that level since I guess early May.
Right.
With the VIX.
I know maybe fewer people. Well, Tom cares about the VIX,
Yes.
and maybe other people care too, because
Right.
it means we're getting a little shaky here.
We are, and we also happen to be in typically the worst 2 months historically when you're looking at from a seasonality perspective in August and September. So you have seen that pick up a little bit this month, and especially when you look over the last 2 months with more of those cyclical quarters of the market, like industrials, materials, energy taking off. You're looking at this month. Most of them are actually losing so far this month, but I mean, we're only 8 days in to August, so still a ways to go there. But we're looking from a volatility perspective. You are seeing that pick up a bit, but still below 20. So even though we have seen it pick up to its highest level in a couple months here, it's still historically pretty low, and it's still around its 10-year average too.
All right, Jess, thanks so much for joining us, giving us that update here on the market. All right, well, kind of the news today, one of the news drivers this morning has been Moody's downgrading the credit ratings of a bunch of the regional, super regional banks. It seems like, where were you when we needed you? But here we are. Chris Whalen joins us, chairman of Whalen Global Advisors. We always love to talk to Chris, particularly about the banks. I mean, Chris, help us out. You're an expert in this rating stuff and the banks. What do you make of what Moody's is doing today?
Good morning.
Morning.
So again, Chris, what do you think about Moody's and their call here?
The Moody's action today was very specific. They were looking at certain banks, and they took the decision to downgrade them. What I think, and that's going to come more, we're going to see a lot more of this, because they're adjusting their entire ratings complex for banks to the changes we see in the market and to the higher interest rates. Basel obviously is going to reduce profitability. So there's a lot of negatives that they're adjusting to. But the thing we have to be aware of is that when you see a sovereign downgrade for the United States, and we can no longer ignore S&P as we have for the past decade, right? We have 2 of them now. So everybody's going to have to use AA+ instead of AAA. And what that means is that the big banks, the ones that get uplift because there's an assumption of sovereign support, are going to go down a notch. And I think you can assume all the agencies will have to adjust. See, in Japan, they give you 2 notches for the big banks. In Europe, they give you 2 notches because there's an assumption that they're going to bail them out. In the U.S., not so much. Fannie Mae and Freddie.
Why not? After what we just saw,
right.
we got essentially a
democracy,
bailout.
We're tempting fate when we have politicians who think they can borrow money forever and who go around worried about global warming and ESG instead of doing their jobs. Then this is what happens. People in the Biden administration were terribly surprised. And it just shows you how there's a lack of seriousness in Washington on fiscal issues. It's stunning. On both sides, by the way.
By the way, Chris, I sat down with Gary Schilling to talk about a lot of this stuff on Sunday afternoon.
Great.
And the one question or the one problem that we don't really see clearly is the possibility of a debt bomb. If we're continually running $1 trillion deficits, at 0% or at 2 or 3%, it's no big deal. But once you climb to 5.5 to 6, it starts to get worrisome. So at what point is it too difficult for the United States to service its growing debt?
Well, it's not just the United States. There's a whole raft of sovereign issuers underneath the U.S., including all the agencies. You have all the states and the cities, which ultimately depend on support from the federal government implicitly, right? So there's a lot going on. And if we do a funding, say, at the beginning of next year, where we're also doing an emergency bailout for a couple of cities that have been downgraded and can't issue bonds anymore at the old spreads, right? So the pricing is going to continue to change, obviously, throughout the whole complex. Pricing is going up for credit. And then some of them are going to be downgraded. I think New York City is going to be downgraded. So we'll be back in the 70s, and I don't think the U.S. is ready for that because we have so much debt at the federal level.
But it makes sense. You know what? I saw Amanda Gordon, who covers hoity-toity parties, right? Big charity events out at the Hamptons and stuff. She had a piece out covering John Paulson, who talked about the rising crime that he's witnessing here in New York and talking about how all his friends are moving down to Florida. Then I saw another piece that New York is going to open a migrant relief center on Randall's Island for another, I think, 2,000 immigrants, but we're already supporting 57,200. If you have the big taxpayers moving to West Palm Beach and we're bringing in, tens of thousands of immigrants, is it going to be a problem for our tax base and for rising costs?
Well, obviously, New York is predicated on having a very strong commercial foundation. They're the ones who pay for everything. All the infrastructure you see in New York City, the metro, everything. You can't do it as a residential community, Matt. You just can't. There's not enough revenue. And if you were to tax the owners of apartments, or you could call them tenants, really, they are in the same boat. You can't possibly tax them enough to pay for everything. So I think you'll see a reduction in services. The progressive mandate that says everybody is owed housing and support as soon as they show up and, say a smile, right, is going to change. Because I think all of these legacy cities in the northern tier are going to have to downsize rather dramatically. It's going to look like Detroit. Because remember, these cities were here for industrial purposes 2 centuries ago. Why are they here today? What's their economic rationale, right? Texas knows why it's here today. They're here to make money. But I'm not sure you want to live down there. What's so funny is a lot of my business friends have moved south to Florida and Texas, but they don't spend the summer there. They're up
No.
here.
Exactly. All of my friends who moved to Florida keep track of the days that they're here in New York. They're like, I can't stay for another 3 days or else I'm going to get taxed
No, but
here.
listen, there are literally hundreds of thousands, if not millions of people who work in mortgage finance and real estate and everything else who have moved out of California and New York and have gone to Texas and Florida because of cost. They literally cannot have a person servicing a performing loan in California today. Too expensive. You might be able to do distressed assets, but you certainly can't do bread and butter, servicing, because it's just so expensive to create that seat for that employee. Can't do it.
All right.
Look, these states have to come up with a reason to exist. I don't care whether it's California, New York, Illinois. They all have to go back to the drawing board and say, why are we here? How do we make money? And that's going to be a tough conversation in New York, I think.
And it's probably got to start in Washington, many would say. Chris Whalen is the chairman, Whalen Global Advisors. Give us some color here on kind of what we heard from Moody's here with the bank downgrade, and Chris suggesting that it's not just the U.S. government, but it will trickle down to everything underneath the U.S. government, including states and cities, and that's where we might really see some pain.
Yeah, absolutely. I mean, if you get U.S. Treasuries at AA+, and you have a fund that can only hold AAA rated debt, you've got to reorganize some things.
Yep, we'll have to see how
Wait, Tucker's shaking his head. Do you not?
No, they're exempt. U.S. Treasuries, in most portfolios, you can only do AAA, blah, 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 except for Treasuries. They're exempt.
Important distinction.
Yeah, clearing it up. We'll stay on top of this story. This is Bloomberg. Let's get some company news right now with Lisa Mateo.
You got it. Shares of Novo Nordisk hit a record high today after the drug maker posted promising results of a highly anticipated study regarding its obesity drug Wegovy. Now, Bloomberg intelligence analyst Michael Shaw in London has more on what the data revealed.
Typically, or historically, obesity has been an out-of-pocket market. So this trial really formalizes a link between reducing body weight and improving cardiovascular outcomes, and that should hopefully provide Novo with the necessary ammunition to go to payers and really drive broader reimbursement.
And you heard John note obesity has been an out-of-pocket market. The results of this study could broaden access to Wegovy for more patients. Shares of Novo Nordisk right now, they're up about 17%. And Paramount's second quarter revenue beat analyst expectations, driven by a lift in its streaming business. Meanwhile, fourth quarter revenue at Fox fell in line with expectations. Bloomberg Intelligence Geetha Ranganathanan explains.
Good pricing power for Paramount as far as streaming is concerned. And you come to Fox, and again, you see good pricing power in the TV product just because of their heavy exposure to news and to sports. So even though we're seeing some pressures in the linear TV advertising business, we're actually seeing both of them post strong digital ad numbers. And so that's helping them recoup some of the losses on the linear TV side.
Now, shares of Paramount right now up about 0.5%. Shares of Fox up about 5%. And Proterra, which has heavy-duty vehicle components like chargers and batteries, has filed for bankruptcy. Those are the company stories. I'm Lisa Mateo, and this is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Stock index is falling right now. S&P 500, the Dow, NASDAQ, all shedding over 1%. You have shares of regional banks. This includes U.S. Bancorp, Key, and Comerica among the biggest losers in the S&P 500. Bank of America, J.P. Morgan Chase, Citigroup also selling off. That comes after that Moody's downgrade. Eli Lilly shares surging right now. They are up over 18%, their highest level on record. They boosted their revenue guidance. Right now, the S&P 500, 47 points lower, down 1%. The Dow, 348 points lower, down 1%. The NASDAQ 100, 243 points lower. That is down 1.6%. 10-year yield getting a little better, 7 basis points lower, 4.01%. New data from the Federal Reserve. Credit card balances surpassing $1 trillion, that's with a T, for the first time. The percentage of Americans who are behind on their payments also, that's on the rise. Delinquency rates now returning to pre-COVID levels. And then there's this separate report from the Federal Reserve indicating the interest rate for credit cards reaching a record high of 22.2% for the month of May. So 22.2%, $1 trillion. What's the cost of servicing that every month? That's got to be a big number.
That's a big number.
Well, unless you pay it off, right? If you don't,
they're not paying
it roll
off.
over. No, some people aren't, and some people are. By the way, a huge jump in non-revolving credit. So auto loans last month shot higher after stagnating for the month previous. So I guess more people are getting car loans. I'm paying very close attention to this because I want one.
Oh, you want a car loan or you want a car?
I mean, I'm getting another car at some point.
I thought you paid in cash.
I'll finance it. Yeah, the Scat Pack.
Yeah, sure.
Probably
never coming.
finance
A
little bit of it.
We've been talking about this for 2 years. The car's never coming. You never get.
I got a message on July 10th that they do plan on building it.
Well, that's nice.
Oh, it's not built yet.
No.
No, but they plan on it. So anyway,
they're going to at some point.
That's good news, I guess.
Dodge, please build my Challenger.
John Tucker, thank you so much. We appreciate it. You know, we've been talking a lot more, and you've been hearing a lot more from our guests, the folks that kind of are in this market as professionals. They're paying more and more attention to dividends. So then it got us thinking, well, how about an ETF that focuses on dividends, and that's kind of what our next guest is thinking about. Nancy Tengler, CIO at Laffer Tengler Investments, joins us. Nancy, thanks so much for joining us. TGLR is a new ETF. Tell us about it.
Oh, gosh, thanks so much. Free advertising. Yeah, we launched TGLR today. It's an actively managed dividend growth strategy. So we focus, and always have, by the way, since 1984, when I got into the business, we focus on relative yield because management at large cap companies set the dividend policy based on what they think long-term sustainable earnings powers is. So it's a great shortcut. We don't have to, worry as much about earnings estimates as we do. Are they able to pay the dividend? Are they able to grow the dividend? And then being an industry leader, which are the names that we own with great management teams, that rounds out the portfolio. So it acts differently than maybe a more traditional equity income strategy. We don't have utilities in this portfolio. We have one REIT because we're looking for growth at the end of the day, just like every other investor.
So Nancy, Matt Miller here. Hi, thanks for joining us.
Hi, Matt.
What holdings do you have in the ETF? What are the biggest stocks that you're allocating?
Well, so one of our largest holdings is Broadcom, which, we bought because of a great capital allocation plan. At one point, they were returning almost 100% of free cash flow to investors. But in addition, as time has passed, we're going to get VMware in this transaction as well. That should be closing soon. And the AI bump, which has really driven the stock this year. But dividend growth has been 5-year annualized about 24%. So that's one of our largest holdings. We are overweight tech in this portfolio, which you maybe wouldn't normally think about in a dividend growth strategy. But there actually are a lot of great companies. Oracle would be another one that pay the dividend, have a yield about in line with the market, a little bit above, and they're growing at about 12% a year. And oh, by the way, they're probably the cheapest generative AI cloud computing platform. So that's kind of giving the stock a new burst. So we own some
AI, Nancy, a lot of people have been saying AI bubble to me over the past couple of days. Analysts on the street are using that term. Do you think this is an AI bubble?
I don't. I think a couple of things. First of all, we know we have a very tight labor force. You're not dragging the baby boomers back in with a net worth of about 75 trillion collectively. So we're going to be living with this tight labor market for some time. And if you go back and look historically in other periods of tight labor markets, what you'll see is that tech spending as a percent of GDP goes up pretty dramatically, 1% to 2%. And then in addition to that, you get the earnings flowing through to the company. So technology stocks have always outperformed in previous periods of labor shortage. This one is predicted by the government to go from 2015, where they think it began, all the way through 2047. So I would use weakness in these stocks to add. I mean, the question is, can they monetize? Microsoft has shown us that they intend to monetize generative AI with their Copilot offering.
So for this ETF, what's a model name to put in there in terms of dividend yield and dividend growth? What do you guys look for in order to put that into this portfolio?
So we start with the valuation, which is relative yield. And what we're looking for are companies who have a dividend paying culture. So they are committed to the dividend. They sometimes state, as McDonald's does, that it's a portion of what they think long-term sustainable earnings power is. But most of these companies, it's implied. So we own some of the usual suspects that you would expect to see in an equity income strategy. So Home Depot would be an example. We also own, we just have been adding to our positions in Starbucks. We own Walmart, but then we also have this exposure overweight, a pretty big overweight to industrials, and then a modest overweight to technology. So these companies have long histories of paying the dividend, and it gives us information as well as it contributes pretty materially to total return, especially the dividend growth part.
Did you do, channel checks looking at the appetite for new ETFs? Obviously, last year was a banner year for ETF launches. We've seen them slow down a little bit this year. It's still strong growth, though. What's your view on the ETF, Nancy, as an investment vehicle?
So I just finished the second edition of my book, The Women's Guide to Successful Investing, and has a whole chapter on ETFs. I think they play a very important role in investors' portfolios. This particular strategy would serve as a core that you would sort of decorate around with more aggressive, higher risk ETFs. We launched it because our minimums are pretty high, and we were turning away a lot of people that were interested in working with us. So this is one way we can, make our strategy accessible to them, and it's been an interesting experience, and the launch went off pretty well today, so we're pretty happy about that.
The expense ratio's a little bit steep, 95 basis points. Does that stay there, or do you bring it down once you get more flows?
I think we bring it down. I mean, I also wrote a whole chapter on how fees are the biggest eroder of total return, and so you need to pay attention to that. So we're very committed in our wealth practice, and then with this fund to be a reasonable access point for individuals and to add value above and beyond the benchmark, which we've been able to do historically in our separately managed accounts.
I thought, Paul, we could ask Nancy about Apple.
Yes.
Because it's a bug in your bonnet.
It is.
It's a bee in your bonnet.
Exactly. So Nancy, you mentioning your overweight tech. How frustrating is it to see a company as great as Apple, with the cash flow it has, to pay a dividend less than 1%?
I know. When we got into that stock, this is the crazy thing. I don't think anyone remembers this. The yield was at 3% in 2013. It was above the 10-year at that time, and they were growing the dividend. So we actually began accumulating our positions at that point, added to it over the years, have basically sold the majority of our holdings. But this particular ETF does have a small allocation, about 2.5% to that particular stock. And I think it is important that management continues to grow the dividend, but they could continue to grow it in a lot more aggressive fashion. So I am a little bit frustrated by that. And some of the other great, technology companies, cloud computing like Google and even Amazon, the only way you can generate income off of those is to sell covered calls. So, but we're not doing that in this particular
Do
ETF.
do cash buybacks make you feel any better?
I mean, yes, but I mean, it's more sentiment in my view. Just like splitting a stock. But yeah, like ServiceNow just announced they are engaging in their first share buyback. That's going to put a floor under the stock at some point. But so we look at that. It's important to us, but it's not our overriding concern when we're looking for new names.
Yeah, looking at Apple, the indicated yield is 0.5%. That's the bad news. I guess the good news is they've 5-year net growth 7.26%, so they are growing it. But again, a lot of folks like myself think we should see a 2.5%, 3% dividend yield on that name. But that's not how they view their use of cash. Nancy Tengler, thanks so much for joining us. Nancy is the CIO of Laffer Tengler Investments, and their new ETF out today, looking at dividends and dividend growth. TGLR is the ticker. Looking at this market right here, kind of holding on to those declines of the day. S&P 500 off 1%, the NASDAQ off about 1.3%, so it's been pretty steady over the last hour or so of trading. The Russell, it's off 1.5%, so a little bit more pain there in some of the smaller cap names. Yields moving a little bit lower. 10-year Treasury now 4.01%. Right now, let's head down to Washington, D.C. We'll get world and national news with Amy Mars.
All right, thank you, Paul. Mexico and Canada have replaced China as the top providers of goods to the U.S. U.S. imports from China fell to $33.5 billion in June, the lowest since the very beginning of the pandemic. Another shakeup for Team DeSantis in the race for the White House.
Ron DeSantis replaced his campaign manager in the third major reshuffle of his operation. Janara Peck shifted to a role of chief strategist, the changeup coming weeks after advisors told Peck her job was secure. The DeSantis campaign recently let a third of its staff go to save money amid concerns about the direction of the operation. Polls show the Florida governor in second place for the GOP nomination, but he trails far behind former President Trump. Steve Rappaport, Bloomberg Radio.
Former President Trump's lawyers going back and forth with prosecutors over how much evidence can be shared with the public before they go to trial. Brown University political scientist Wendy Schiller says there's a difference between talking about the case and witness tampering.
Trump cannot get on the phone and call people who've either already testified or given deposition and try to persuade them not to testify or to change their testimony. That's witness intimidation, witness tampering. He nor his legal team or anybody associated with him in this effort, can't do that.
Brown University's Wendy Schiller was a guest on Bloomberg Daybreak. New York City prosecutors say they've charged a Queens doctor for sexually assaulting patients. Bloomberg's Michael Barr reports.
G. Allen Cheng was charged in connection with the alleged sexual abuse of at least 6 women.
Prosecutors say several patients were drugged, filmed, and assaulted during hospital appointments at New York Presbyterian Queens. Cheng was also arraigned on charges of sexually abusing 3 other women inside his apartment in Queens. The 33-year-old pleaded not guilty to the charges. In New York, Michael Barr, Bloomberg Radio.
Global news 24 hours a day, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Amy Morris, and this is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
Tucker in the Bloomberg Newsroom with his Bloomberg Business Flash. It is risk-off sentiment continuing today. 10 of the 11 major industry groups in the S&P 500, they are lower right now. The financials, biggest drag for the index. This comes, of course, after the downgrade of 10 banks by Moody's, maybe more in the pipeline. Investors heading to the safety of treasuries in part. That's pushing the 10-year yield down 7 basis points. It was at 10, right now 4.01%. on the 10-year Treasury. Apple shares, they're lower, headed for the longest sell-off there since early 2022. Meantime, at Principal Asset Management, Seema Shah sees economic pressures mounting in the U.S.
Things are not out in the clear yet. There is still going to be some impact from Fed hikes, particularly for the regional banking sector, and it still has to flow through to the economy.
This week features the big inflation report, get the CPI on Thursday. Ahead of that, Federal Reserve Bank of Philadelphia President Patrick Harker saying the U.S. Central Bank may be able to cease interest rate increases. S&P 500 right now 46 points lower, down 1%, 4471 on the index. The Dow Jones Industrial Average down 353 points right now. And the NASDAQ 100, 227 points lower. That's a decline of 1.5%. We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Matt and Paul.
All right, John Tucker, thank you so much. We appreciate that. As always, Matt Miller, Paul Sweeney, live here in the Bloomberg Interactive Broker Studio. We are streaming on YouTube, so just head over to YouTube and search Bloomberg Global News, and that'll bring you to the video feed. I want to get right to our next guest. Margie Patel, Senior Portfolio Manager at Allspring Global Investments, joins us. Margie, I want to get the benefit here of your experience here. We're pretty much through earnings for this cycle. What are your takeaways?
Well, once again, the second quarter surprised on the upside like the first quarter did. Shows that companies are in good shape, revenues are okay, profit margins are holding up, which is very important. And really, there's no sign that companies are seeing any kind of a broad brush decline in economic activity. So the outlook for third quarter looks at least reasonable. So maybe better than people have been thinking, and the whole thought of a recession once again seems to be pushed out a little bit over the horizon.
So, Margie, when is your expectation for a recession? Because all the signs are there, and I realize that the current and backward-looking data still aren't as bad. On the other hand, the Fed raised interest rates 550 basis points in like a year and a half, so it's coming, right?
Well, it's coming, but we may have to wait longer than people think. I think several reasons. One, corporations have spent the last decade of near zero rates restructuring their balance sheets, so they really aren't as sensitive to higher short-term rates as they have been in previous cycles. Same thing with consumers. We're having a little bit of a slowdown in housing, but many homeowners were able again to refinance, lock in long-term low rates on their houses. So they're not actually hurt. And in fact, I'd say at the margins, consumers are probably benefiting from getting higher rates on their savings. With unemployment at 3.6%, it's very, very hard to say that we're on the brink of recession, and especially when there's no sector of the economy you can point to that's about ready to tumble over into distress, to feed over into some kind of a general recession. So I just don't see a recession anytime near term.
Well, Margie, given that background, is it reasonable for some people, like in the fixed income space, to maybe take on some incremental risk in terms of maybe moving out in duration, maybe even moving to high yield debt? How do you think about that?
Well, high yield has not been very risky last year or this year. It's actually still the best performing part of the fixed income market when you look at maturity adjusted. And I think it will still be probably above average compared to treasuries. The way I look at treasuries, we have such an enormous amount of supply that has to come, that has to be absorbed. That says to me that we may have a relative scarcity of corporate credits that people would like to buy versus treasuries. So we might actually see yield spreads, the amount of extra yield you get in corporates over treasuries, shrink from these levels. And remember, defaults are only a little over 3%. So even in the high yield market, you're not seeing much distress.
So, all right, if no real recession this year, I mean, how should we think about this equity market, which has really been driven this year by those Magnificent Seven stocks? Do we start to try to rotate maybe out of them, or maybe try to diversify way out of them into some mid-cap stocks, maybe some cyclical names?
Well, I still think the better trade is with larger cap stocks because we don't really know what's going to happen. Secondly, it looks as if growth in the second half of the year will continue to be, I think, very, very modest. So high growing companies will be hard to find. So I think that some of the very large cap stocks have been favorites so far this year may well continue to perform because they still have the guaranteed growth. So we're looking more for large cap companies where they have either an industry that's on a secular upswing or a cyclical that looks as if they can continue to have above average earnings.
That's pretty amazing. Because it seems like, Margie, the biggest companies on the S&P 500, then Apple, Microsoft, Amazon, Nvidia, Alphabet, Meta, maybe Tesla. These companies you're looking at as growth companies, but also, in a sense, safe havens.
Well, that's right. And ever since the first quarter, when they all produced pretty good earnings, they have acted as safe havens. Certainly, they have enormously liquid balance sheets that they are a safe haven. And I think from here on, the market's going to look at these stocks more individually. For example, we saw Apple really come down a bit since they reported rather disappointing results. And some of the other FAG names, Microsoft, Meta, have produced very good results. And so those have continued to chug along and advance. So we think it's really going to be determined by results. Are these high growing stocks still high growing, or any of them running into roadblocks that may take them down? So we think it'll be more individual. We still think in general, the larger companies will tend to do well because they have all the strengths to operate in a low growth market.
Margie, earlier today, Matt and I were talking with a guest whose firm launched an ETF today that focuses on dividends, dividend growth, and dividend yield. How do you think about dividends?
Well, I think dividends are nice, and in a slow growth market, which I think we'll now be in, probably dividends will be a bigger component of total return for stocks than we've seen over the last, say, 5 years or so. However, I still think it comes down to individual stocks, not so much a dividend rate, because often stocks that have high dividend yields are likely to be equity underperformers. Stocks with low dividends are likely to raise their dividends over time. So rather than an ETF, one size fits all, we'd rather just look at companies that have, we think, the ability to raise their dividends or reasonable dividends for the growth rate or likelihood to raise their dividends.
Are those companies going to be some of the same that are the Magnificent Seven? I mean, are they going to be growth companies, safe havens, and able to raise dividends?
Well, I think companies are pretty cautious about raising their dividends more so than buying back stock. So we still think that the technology sector will have companies that raise their dividends. We think the industrial sector has turned the corner, and we think they're likely to have higher cash flow and raise their dividends. And even in some of the healthcare names, healthcare looks as if it's under a cloud from hangover from COVID and different things. But we think even there we should see some modest increases in dividends over the next year or two.
How about energy, Margie? We're looking at WTI crude oil at just under $82 a barrel, up from about 67, 68 just about 5 weeks ago. So how are you guys thinking about the energy space?
We have very modest exposure in energy because we really aren't interested in making a play on the price of oil. We think there's a lot of roadblocks politically for some companies really expanding their earnings the way they might like to. So we're kind of lukewarm on the sector.
All right, Margie, we really appreciate getting a few minutes of your time. Margie Patel, Senior Portfolio Manager at Allspring Global Investments, still keeping a relatively optimistic outlook on the risk assets, even in a slower growth environment.
Yeah, absolutely. And still looking at those big ones. You keep asking if you should take profits from those, right? I know. Because you've done so well with them thus far.
Yeah.
But the thing is, it's a relatively safe place to hide.
Which is so odd the way you phrase it. I mean, again, these high growth names as kind of safe havens in what is a slowing economy.
I wonder if that's happened before.
I don't know. I can't imagine.
We need to ask Sam Stovall. When's the last time that happened?
We'll
that
get
you had
that. Exactly.
The biggest companies offering growth and safety.
Safety at that valuation, which a lot of folks are calling out. Boy, if nothing else, we got a valuation bubble in some of these names out here, and therefore sets up a very high bar for earnings, which we saw with Palantir today, stock trading down. This is Bloomberg. Let's get some company news right now with Lisa Mateo.
You got it. Trucking firm Yellow has received some help from creditors to buy time to sell off its trucks and terminals. But the almost $143 million loan comes with a hefty 17% interest rate. Bloomberg's Gina Cervetti says that's not all.
It also carries a $7 million fee that could jump as high as $32 million if the bankruptcy drags on. The higher fees don't kick in unless Yellow fails to repay more than $700 million in pandemic-era loans from the U.S. government.
Now, shares of Yellow down more than 6%. And Moody's Investors Service has cut credit ratings for 10 small and mid-sized banks. Bloomberg's Joan Doniger has more on which firms it includes.
M&T Bank and Pinnacle Financial Corporation, but it also names big lenders such as Truist, U.S. Bancorp, and some others as possibly being next. Moody's cites higher costs, potential weaknesses when it comes to the amount of capital the banks put aside, as well as higher risk from commercial real estate loans with weaker demand for office space. Investors have been rattled by the collapse this spring of several regional banks.
All right, checking with shares of M&T Bank right now. They're down about 2.5%, more than 2.5%. Pinnacle right now down about 1%. And Tesla merch is being taken to a whole new level. Who could forget the $250 tequila bottle after Musk tweeted about Tesla Tequila? Well, there have been flamethrowers, perfume, even surfboards. Now get ready for a Cybertruck-themed cat box. Yes, for your cat. Business Insider reports it's made of moisture-resistant cardboard and sells for about $13, but it's only available in China, at least for now. I'm Lisa Mateo, and this is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, Matt Miller, Paul Sweeney here in the Bloomberg Interactive Broker Studio. S&P 500 off 1.1% towards the low of the session. NASDAQ off 1.55%. 10 years yields pulling back down 8 basis points, 4.01% on your 10-year. We were below 4% at 3.98. That's the low of the day. WTI crude oil off 0.5%, $81.49. Bitcoin, it finds a bid out there. It's up 1.3%. How about that? $29,550 for Bitcoin. Right now, let's head down to Washington, D.C. We'll get world and national news, and we'll do that. Amy Mars.
Thank you, Paul. First Lady Jill Biden is leading a discussion at the White House today on how schools can better combat hacking and cyber threats. The White House plans to work with local governments and private companies to shore up schools' cybersecurity. Homeland Security Secretary Alejandro Mayorkas told educators that his agency is committed to coming up with answers.
The education ecosystem, like critical care units in hospitals, should be sacrosanct, free from cyber attacks and other threats. Children deserve the ability to learn and grow in a secure setting, and you all deserve the ability to focus on what you do best.
Amazon Web Services is offering $20 million to combat cyber crimes. That money will go toward helping K-12 schools with training and resources if their systems are attacked. Severe storms have slammed entire regions of the eastern U.S.
Thousands of flights were canceled or delayed yesterday, and more than 1 million customers lost power as storms moved through the region. The wild weather prompted tornado watches and warnings in 10 states from New York to Tennessee. The Knoxville Utilities Board described damage across its service area as widespread and extensive. News outlets reported the storms toppled trees and power lines in multiple states. The National Weather Service also issued a flash flood warning in Maryland after 4 inches of rain fell in a short time. Steve Rappaport, Bloomberg Radio.
Meanwhile, virtually every Florida city is breaking records today as temperatures soar. Same in Texas, which continues to see triple-digit high temperatures across that state. And demand for electricity has hit record highs, the 8th time this summer, as homes and businesses are cranking up that air conditioner. Meanwhile, the city of Juneau, Alaska, has declared a state of emergency after a glacial dam burst, causing historic flooding with damage well into the millions. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Amy Morris, and this is Bloomberg. Paul and Matt.
All right, Amy Morris, thank you so much. We appreciate it. Here's a headline on the Bloomberg Terminal that gets your attention. Tainted medicine fears spur Pentagon to seek outside testing. That's the U.S. Department of Defense entered an agreement with Valisure, an independent lab that spotted dangerous chemicals in a variety of widely used pharma and consumer products to test medications amid surging concerns about generic drug quality and shortages. That's not good.
Yeah, no, it's not good at all. And, Business Week has done a couple of stories over the past month about tainted drugs that have been killing people. Right here in this country, you had eye drops that were manufactured in India, which killed some people, and others went blind because of them. But I guess Valisure, this company, I would guess it's Valisure because you want to be sure, right? So validation and sure, that's a portmanteau.
Yes.
Under a multi-year agreement, Valisure.
I look up that word every time it comes up on my crossword. What is portmanteau?
It's when you combine two. Yes,
like
validation
motel,
and
motor and motel, whatever. Okay.
Motel, yeah. Yes. So under a multi-year agreement, Valisure will test dozens of drugs for dangerous chemicals and rate manufacturers' quality to help the department weed out potentially substandard treatments. This is according to a statement from the laboratory. I guess Valisure is based in Connecticut. This partnership is a cooperative research and development agreement to exchange information. The Pentagon will not pay Valisure.
Oh, okay. Well, here's some scary numbers. 9 out of 10 drugs consumed by Americans are generic, low-cost copies of innovative medications whose patents have expired. Concerns about the generics industry, which is largely based in India and China, as you mentioned, have exploded as the U.S. encounters shortages affecting drugs such as life-saving cancer therapies made at a plant in India found to have major quality shortfalls. So a big issue, and it's even affecting the Pentagon. We'll have more coming up. This is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
We got a lot of green on the screen here, but the volume is light.
We constantly underestimate the strength of the U.S. consumer.
This is a market that's much more optimistic or bullish than maybe the central bankers are.
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
The supply chain has still got dislocations globally and here in the U.S.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, coming up in this hour, we're going to talk to Geetha Ranganathan. She covers all the media stocks for Bloomberg Intelligence. Why? Mickey Mouse reports earnings after the close tomorrow. We'll get the latest on Disney as well as the other media companies that are reporting this week. And then I think the conversation of the day, Mikey Shaw, senior industry analyst of Bloomberg Intelligence. He covers all the pharma companies. So we'll talk to him about these obesity drugs that are just really moving stocks today. We'll get the expert opinion there. That'll be fun. And then for Matt, C-suite conversation of the day, Ryan Lockwood, CFO at Car Parts. Talk about the car business and parts and all that kind of stuff. People are keeping their cars for longer. That means they need more parts. That's what
I'm very much looking forward to you having that conversation with Ryan.
Oh, because you bail on me.
Yeah, because I have to go and prep for the crypto show. 1 o'clock p.m. on Tuesdays, folks, on Bloomberg TV every week.
But what was yesterday?
Yesterday was the ETF show.
Oh, okay. All
so
right.
1 o'clock p.m. Mondays, folks, every week. That's the ETF show, and then Tuesdays is the crypto show.
All right, just trying to keep...
I skipped the last block for each of those days.
Right, but you still get paid as if you were here. Okay, very good. All right, let's go over to Charlie Pell and get a Bloomberg Business Flash.
Hi, thank you very much. And here's what's going on. Stocks very close to session lows right now with the Dow, the S&P, NASDAQ 100 index, and yes, the Russell 2000 right now all in the red. We've got the S&P down 48. That is a drop right now of just about 1.1%. Dow Industrials down 335 points for the Dow, a drop right now of about 0.9%. NASDAQ Composite Index lower by 1.5%. We've got the Russell 2000, the index of small cap shares, down 1.5%. 10-year yield 4.01% with a 2-year right now 4.77%. Spot gold down $10 the ounce to $19.25. That is a drop of 0.6%, while West Texas Intermediate crude down 0.3%, 81.69 a barrel. United Parcel Services lowered its full-year profit forecast as the courier contends with shifting consumer habits and rising costs after a tentative labor agreement. Shares of UPS down now by 0.3%. Rival FedEx up 1.6%. Lee Klaskow tracks the logistics industry for Bloomberg Intelligence, and he was a guest right here on Bloomberg Markets.
They can raise prices, which will mitigate the inflationary pressures that they're facing. The first year of the new labor contract, there's a big step up in cost for them. So it kind of barbells in the first year and the 5-year in terms of the step up. It's around a 3.3 CAGR in terms of inflationary pressure, and that includes not only the wages that they're getting paid, but also the benefits. So if you look at it through the whole 5 years, it's really not that bad, but the first step up is going to be a big headwind. So, we think that they can go back to earnings growth in 2024.
CAGR is a compounded annual growth rate. If you were wondering about the jargon, we thank Matt Miller for asking just what CAGR stands for. You can hear more of the conversation on the Bloomberg Tape podcast. You can download it wherever you get your podcasts. Again, recapping, stocks are lower across the board with the S&P down 47, a drop right now of 1%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. We appreciate that as always. Bailey Lipschultz, he joins us here in our Bloomberg Interactive Broker studio. He was invited. Some of the others that are in the studio, not so much. Bailey,
we had Carol Masser and Tim Stenbeck in here,
causing trouble,
breaking in the studio.
Yes, exactly.
Harassing us, frankly.
Harassing us. And I was catching a little bit of guff there for taking Fridays off.
Yeah, well, I mean, if you take a tea day, if you take an actual day off, that's fine. What you don't do is mail it in on Friday and say you're working from come home.
Yeah, that doesn't happen.
You know?
And plus, the day after Thanksgiving, who's here all day broadcasting like from sun up to sundown? Me.
Yeah.
And of course, the Christmas week, I'm here. So
With me,
you guys
dude.
can take your little vacations and go do what you need to do. Billy Lipschultz, he's here. He's in this studio. Not a good day in the markets. What are you looking at, Bailey?
No, a lot of weakness. Everyone wants to blame financials. Financials, worst performer among the big industries sectors in the S&P 500 right now. S5 Financials down 1.6%, but tech not doing too well. The Nasdaq 100 actually underperforming S&P 500. Green on the screen only really in healthcare. Paul, not only is Eli Lilly up 16%, but we have good earnings across the board. Organon up 9%, ticker OGN. Zoetis outperforming right now, up 3.5%. Amgen up 3.9%. All on the back of good earnings and obviously the strong, really strong results for Eli Lilly's weight loss drug. We had good data from Novo Nordisk, that also trading at a record high. But guys, stocks that are underperforming, Dexcom down 9.4%, Insulet down 6.5%. They make diabetes insulin pumps. So now a little bit of read across right now with people losing weight, maybe not having diabetes, not having to be in tap with their pumps, seeing weakness on those medical device stocks.
Eli Lilly, they have a competitor to the Wegovy Ozempic class of drugs, right? It's called like Retratitude or something. Retatrutide. Why do they always make these things impossible to pronounce?
No
and
idea.
they're not based in reality at all. But apparently, I'm looking at a story from WAPO last month. They tested out this new drug, and people were losing 30% of their weight after 48 weeks. And the doctors running the trial said some people had yet to plateau, suggesting they could lose even more weight. If you lose 30% of your body weight, isn't that a problem? Isn't that a health issue? For you, that would be a problem.
Well, I think for a lot of people that this drug is intended for, that's a good thing.
Yeah, I guess.
Right? I mean, particularly in this country.
Yeah, I mean, you walk around.
30%, so I'm 209.
60 pounds? 60,
yeah.
60 and change.
That'd be a problem.
I'd be.
How tall are you?
If I were 140, I'm 6'4".
Yeah, that's not good.
That'd be less than me. I'm 5'9.5" on a good day and 160, so.
You're in great shape. Bill, you're in fantastic shape.
Thanks, Matt. You know, work out in the morning every day at 5 a.m. when I come in the office.
So really?
Get up and at it.
Commitment. That's good. You do that, and I'll take the drug.
Yes. One other stock that is outperforming as well off that company formerly known as Weight Watchers, WW up 16%. But looking at the worst performer, guys, in the S&P 500, International Flavors and Fragrances, IFF, down 18%, plunging the most since at least 1980 on a guidance cut. Weak consumer demand driving down their sales expectation. Divested 3 divisions, exploring more. So quite the underperformance for a company based here in New York, weighing on at least some peers so far.
International Flavors and Fragrances, IFF.
That's still a $17 billion company.
Yep. Company went public in October 1st, 1961. Smith Barney took them public at $24 a share. How about that?
Bailey doesn't even know Smith Barney is.
No, but he doesn't. 1961 is a foreign concept. All right, what else you got for us here today? Anything moving to market?
The VIX is, by the way, 18 for the first time since May.
Man.
So I've been ignoring the VIX for about 8 years now, but it's starting to matter. Is that possible or no?
I think as long as, again, in my specialty, my wheelhouse is IPOs and ECM, if you're below 20, it's smooth sailing. We're still at 18. You mentioned it. We're up 12% today, but really, if you stay below that 20 level, and when I talk to some broader PMs, that's kind of the area that they're keeping an eye on. And right now, again, you look at the kind of ebbs and flows. 20 is still really where we've been at for the most part since late March, and obviously that was in the wake of the banking crisis or uncertainty, if you will. So it does seem like volatility is inching up, but that could just be some seasonality concerns, just given kind of what typically happens in the month of August. One outperformer, though, for you guys before I go, Fox Corp, Class A shares up 4.5%, strong results to finish the year, and as you mentioned, maybe that along with the Paramount results will put a little bit of pressure on Disney and their print tomorrow evening.
Boy, that is a perfect segue, as we would say, to our next guest. But Bailey Lipschultz, thanks so much for joining us. Bailey covers all the markets for us, joining us here in our Bloomberg Interactive Brokers studio. Also joining us right now is Geetha Ranganathan. She covers all the media stocks for Bloomberg Intelligence. And Geetha, you're busy this week. This is the week when we get the earnings from the big the big media companies. Talk to us real quick before we get to Disney. What do we hear from Fox and from Paramount today?
Yes, I think, Paul, it's not been as bad as feared, I think, with the media companies. And there are a couple of different things here. So one thing is on the free cash flow front. So remember, all of these media companies, because of their streaming efforts, were kind of bleeding cash. We saw less of that happen this quarter. That's partly because of those dual Hollywood strikes. Plus, there is generally like this content cost rationalization that has taken over the industry. So I think both of those are definitely helping. And then on the linear TV side, obviously a lot of pressures, especially with linear TV advertising. But the good news for both Fox and Paramount was we saw that their digital ad, so their streaming ad growth is doing really, really well. So Fox has a product called Tubi. They said that product had 47% revenue growth. And then, Paramount has Pluto, which again, there was a reacceleration in digital growth there. So not enough growth to completely offset TV losses on the ad side, but it's definitely kind of stopping the leakage a little bit. So both those things, I think, definitely working in favor of media right now.
All right, you mentioned the strikes, and that is that's a big issue for the media companies. And then I see Disney. News today, they've created a task force to study artificial intelligence and how it can be applied across the entertainment conglomerate. That's even as Hollywood writers and actors battle to limit the industry's exploitation of the technology. I mean, are they tone deaf over at Disney? What did you make of that news? Because we're going to hear from Disney tomorrow after the close with their earnings.
Yes, it's coming at a very fragile time, right? So this is a high stakes moment for Hollywood, right? There is this double writer strike, actor strike going on. But I think the way that Disney is kind of looking at this is, nothing can really stop technology and change. And I think the only option right now for Disney, if you kind of just look at it from their perspective, or even Netflix for that matter, is they got to kind of go with the flow and embrace it. And I think the way that they're saying, or at least the way that they're presenting their argument is that, AI doesn't necessarily need to be negative, right? It can probably also empower creativity. It can probably empower these writers and content creators to do more. So they're kind of trying to position it more as something that should work in harmony with them, not necessarily replace them. Of course, for the actors and for the writers who are on strike, I don't know if that's going to sit well with them, but that's what they're saying.
I would think the same thing, right? If I was a writer, I would embrace AI. No. I mean, it's not going to go away. You're not putting the genie back in the bottle.
And it's a risk. I think it's a risk to every content creator out there, including us, including reporters, including content creators.
I think it's going to be a help. I mean, you can use it as a fantastic tool. I already use it every day. Let me ask about sports, about ESPN specifically, Geetha. What do you think about, and I guess we're going to get a little bit speculative here, what do you think about the possibility of leagues buying essentially shares in, this distributor of their content?
I think it definitely makes sense. I mean, we're seeing kind of the sports model unravel a little bit. So definitely on the local sports side, we've seen the regional sports network business almost completely come apart with the bankruptcy of Diamond Sports. And so, those rights are kind of all up for grabs. We're seeing local TV stations kind of go after that. So now you have the national TV business, which is obviously, led by ESPN. They are absolutely the behemoth when it comes to sports broadcasting. And so I think it does make sense. But again, for them, the writing is on the wall with cord cutting, and it does make sense, I think, for the leagues to kind of own a bigger, maybe a portion of that and have more kind of skin in the game, if you will. Because we do know that ESPN has to, at some point in time, kind of go over the top. There's no question about that. It probably happens, when the new NBA deal kind of gets finalized, which should happen sometime in 2024, 2025. So, yeah, I think it definitely makes sense. Again, I don't know exactly how much they're going to be willing to commit.
Geetha, Disney reports after the close tomorrow, a conference call tomorrow evening. How much pressure do you think shareholders and analysts will put on Bob Iger to articulate a succession plan and one that actually works this time?
Yeah, that's that this continues to be a big pain point for Disney, Paul. But one thing, and this was kind of an interesting development, and I think we spoke about this a few days ago as well, was him kind of bringing on Kevin Mayer and Tom Staggs in consulting roles. Now, I don't know if that's just purely for consulting or whether he is trying to do something else on the succession front. But I think definitely there is going to be pressure on him to articulate a strategy. Of course, we have a little bit more time. His contract just got extended by 2 years. But at the end of the day, it's going to be all about what he says tomorrow in terms of strategic direction. And of course, succession continues to be a major, major issue for Disney.
And, Geetha, one of the many strengths of Disney has been its theatrical business. The franchises it has for its film, whether it's Marvel characters or Star Wars or Pixar, it was just for 10, 15 years, dominate the box office. Now, I've actually heard some people say maybe that strategy's kind of old. I mean, you look at Barbie doing $1 billion in box office. Maybe the market's gotten tired of some of those franchises. What do you think?
Oh, yeah, absolutely, Paul. You're absolutely right. I mean, those were hit machines for years. You're absolutely right. But now they do seem tired, right? I mean, whether it's Marvel, I mean, Pixar, I mean, Disney used to be the animation king, no questions asked. It hasn't produced an animation hit now for many, many months. I mean, if you look at the top animation studio right now, it's Universal. I mean, whether it's Super Mario, whether it's, Minions, I mean, that studio is churning out hit after hit. So it's really getting a little bit worrisome for the content engine. It's clearly broken. Bob Iger needs to do something to kind of reinvigorate these franchises. And you're absolutely right. I mean, look at Barbie. It came out of nowhere, and this is grossed over $1 billion. And we're seeing kind of similar successes with even with Oppenheimer. So people are looking for content, but it needs to be fresh. It needs to be engaging. And I think Disney is definitely getting that message.
What's Disney going to do about Hulu? I can't even remember who owns it now and who wants to buy it, but it's a big streamer out there.
Yeah, it's 2/3 actually owned by Disney and 1/3 by Comcast, and so they have a deadline that's coming up in January. And Bob Iger has kind of indicated pretty openly that he is going to kind of put up the $10 or the $12 billion that he needs to in order to buy out Comcast. So yeah, that is going to become actually a part of Disney Plus. It's part of their bigger strategy when it comes to streaming. So again, we'll have to see how he kind of ponies up that money.
Does streaming is not cash flow positive for Disney yet? Is that correct?
Not yet.
Tell that to the strikers. Tell that to the strikers. Because they think it makes $30 billion a year.
So when do we think the streaming business will turn profitable for Disney?
Yeah, this has been a little bit of a pain point, right? So we actually thought that they might turn positive, a little bit sooner. Initially, I mean, all the projections were pointing to about 2024, but that was when we expected like pretty explosive growth on the subscriber front. But now that subscriber growth has kind of cooled off pretty dramatically, yes, they're raising prices, but I'm not sure that's necessarily going to be able to offset it. So we might kind of see actually a push down in that profitability target down to fiscal 2025. That said, we're seeing other companies actually do pretty well. So Warner Brothers Discovery comes to mind. They are already projecting being EBITDA profitable this year.
Oh, okay.
So again,
all right.
Yeah, so content cost rationalization, yes, it is working.
All right. Geetha, excellent stuff as always on top of the global media biz. Geetha Ranganathan, she covers global media for Bloomberg Intelligence. Disney reporting numbers after the close, widely anticipated. This is Bloomberg. Let's get some company news right now with Lisa Mateo.
Good morning. Shares of Novo Nordisk soared to a record high today thanks to results of a new study regarding its obesity drug, Wegovy, that it said cuts the risk of heart attacks and strokes by 20%. Bloomberg intelligence analyst Michael Shaw in London says the results could broaden access to the drug.
Typically, or historically, obesity has been an out-of-pocket market. So this trial really formalizes a link between reducing body weight and improving cardiovascular outcomes, and that should hopefully provide Novo with the necessary ammunition to go to payers and really drive broader reimbursement.
Now, shares are up right now more than 17.5%. Meanwhile, Eli Lilly raised its full-year outlook after its diabetic drug hit nearly $1 billion in sales in the quarter. Bloomberg's Simone Foxman has more on Mounjaro.
It's currently approved for type 2 diabetes, but it's likely to be approved as a weight loss drug later this year. Those strong results for Mounjaro in terms of revenue this quarter, substantially boosting the full year forecast by $2 billion, boosted earnings per share expectations for the full year to $9.70 to $9.90, up from $8.65 to $8.85.
Now, shares of Eli Lilly are up about 16%. And Dish Network wants to buy EchoStar, the satellite network operator it once owned, in an all-stock deal. The struggling TV business hopes to head toward a future in wireless communications. Now, shares of Dish right now up about 7%, almost 8% right now, and EchoStar is down just a fraction. Those are the stories we're following. I'm Lisa Mateo, and this is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 12:21 on Wall Street. We do check markets all day long at Bloomberg. We have got the Dow, the S&P, NASDAQ, all in the red. Stocks are falling around the world as traders rush into bonds after a raft of news on China, Italy, and the U.S. Fan worries about the financial system and the global economy. 10-year, 4.01%, with the 2-year now yielding 4.77%. The S&P closed to session lows, down 42 points now, a drop there of just about 0.9%. We've got the Dow down 306 points, a decline now of 0.9%, while the NASDAQ Composite Index is down 179 points, a drop right now of 1.3%. Spot gold down $9 the ounce to $19.27, a decline of 0.5%. West Texas Intermediate crude closing in on $82 a barrel, up 4 cents right now, little changed, $81.97 a barrel. Moody's has lowered credit ratings for 10 small and mid-sized American banks and says it may downgrade major lenders, including U.S. Bancorp, Bank of New York Mellon, State Street, and Truist Financial, as part of a sweeping look at mounting pressures on the industry. Right now, we've got shares of U.S. Bancorp down 1.7%. Shares of Bank of New York Mellon, they're lower by 2.3%. State Street down 2.7%. And Truist down now by 3%. Again, recapping, stocks are lower with the S&P down 42 points now, a drop of 0.9%. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. We appreciate that. Matt Miller, Paul Sweeney here in a Bloomberg Interactive Brokers studio. We're streaming live on YouTube, so just head over to that intraweb thing and search Bloomberg Global News, and you'll find our video feed there. Eli Lilly, Novo Nordisk, two big pharma companies all-time highs today. Look at those charts. They're just absolutely monster charts, particularly in the last 20 years. So we're going to figure out what's going on there. Something about an obesity drug here and reducing heart attacks. All good news, all big news. But we need to talk to somebody who is actually an expert in this stuff. Michael Shaw, Senior Industry Analyst at Bloomberg Intelligence. He's based in London. Mikey, thanks so much for joining us here. Could you tell us what is going on with the Novo Nordisk and also by extension Eli Lilly? What's going on today?
Yeah, so Novo basically had a landmark trial readout. So it looked at Wegovy and cardiovascular outcomes. Now, the base case for this was a 70% risk reduction on cardiovascular outcomes. And really, with the result, we saw like a home run result. So it actually reported a 20% benefit. And what's more is that all drivers of the composite endpoint, so heart failure, stroke, and cardiovascular death, they all drove that benefit. So really a home run result for Novo there.
Mikey, the main question people ask me, and that I also want to know the answer to about these drugs, is what could the long-term effects be? You know, if you're shooting yourself in the leg with these every week for the next 10 years, what happens to your body?
Well, I think it's clear that we've seen substantial weight loss associated with these products. So Novo's Wegovy's showed up to 18%. Tirzepatide showed more than 20%. In terms of the side effects, well, I mean, initially, the GLP-1 class in general is associated with GI side effects, so gastrointestinal side effects, things like nausea, vomiting, etc. This is a class of drug that's been used for years in diabetes, and there have been kind of anecdotal reports of things like suicidal ideation that we've seen in the news recently.
Hang on, say what? What is it? Suicide?
Suicidal ideation, yes.
Oh boy,
but you got to also remember, these patients are, obesity, and there could be actually other things contributing to that. So nothing's been seen nothing was seen in the clinical trials, in the large clinical trials. I think the safety of these drugs is kind of well documented, and there's been a lot of experience already with diabetes.
All right, so just to sort out what's on the market here and who owns it,
Mikey and his team did a big report on just this whole place, this obesity stuff.
I mean, I think this could be a game changer for the Western world. Obviously, if there are no long-term side effects, I don't want to be giving birth to a three-eyed fish later. But so Novo Nordisk does Wegovy and Ozempic, right? Those are both from Novo Nordisk. And then Lilly has tirzepatide as well as retatrutide. Is that right?
Yeah, that's correct. Yeah, so basically Wegovy and Ozempic are both the same molecules, just Wegovy is a higher dose that's marketed or approved in obesity. Ozempic is approved in diabetes. Tirzepatide is marketed under the brand name Mounjaro for diabetes, and it should get approved in towards the end of the year for obesity. And then retatrutide is a compound that they've got in their pipeline, which has shown potentially better data than tirzepatide on weight loss. So that's something coming through the pipeline.
All right, but anytime I talk to you, Mikey, or Sam, it always comes down, Sam Fazeli, your partner in crime, it always comes down to who pays for this stuff. So who pays for this stuff in the big markets around the country?
I saw, by the way, that the University of Texas has taken these drugs off of its insured coverage list because the University of Texas system was paying $5 million a month for its employees to get hold of these things.
So I mean, that's a key question at the moment, given the size of the potential size of this indication. Historically, what we've seen with these drugs is obesity. It's been kind of more of a lifestyle choice. It's been an out-of-pocket market. But we haven't seen the weight loss data that's associated with these drugs historically. So now with this outcomes data in hand, that's really going to drive broad reimbursement. And I think it's going to be tough for payers to kind of not cover these drugs if Wegovy is showing a 20% reduction. in kind of cardiovascular risk. And recall that heart failure is kind of one of the leading causes of death in the US. And also it has, costs associated with it, which are kind of a significant burden on the healthcare system. So, the long-term savings, that these drugs could potentially offer, are going to be huge. So it's kind of...
Of course, you could achieve the same savings, or certainly similar savings, if people would just eat less ice cream and go to the gym more often, right? So that's the problem.
That's true too.
That the insurance, that the companies paying for the insurance probably have. Like, my employees either make horrible choices and take this drug, and then I pay $5 million a month, or my employees make good choices and I don't pay anything and no one needs to take drugs.
Yeah, no, that's true. That's true too.
All right, Mikey. All right, that's the obesity side. I got my plays there. I know how to do that. Another big area that we'd love to see some breakthroughs, and maybe your companies will do it, is just kind of dementia, broadly defined, as the world's population ages. It becomes a bigger and bigger problem for a lot more people. What's your industry? What's a biopharma industry? What are they doing there?
I mean, we've seen. It's not my area of focus, but we've obviously seen Leqembi from Biogen and Eisai come through, and then we've got Lilly with donanemab. So these are treatments for Alzheimer's. Lundbeck as well has shown kind of positive data for Alzheimer's agitation. So that's like a supplemental indication for one of their drugs, Rexulti. These are. This is an area where, the success rate has not always been high, and drugs associated with or being developed in these areas are kind of highly risk adjusted. I guess it remains to be seen. It's not an area that I focus on in particular. So I leave my colleague, Sam Pizzelli, to look at that.
Please.
But there's certainly kind of developments in the pipeline.
All right, so what's next for, the Eli Lillys of the world, the Novos? These stocks all-time highs. What do you think they do? Are they continue to go out and buy what they can't develop? It seems like every Monday we come in and there's a big pharma M&A trade.
And does anybody else make one of these appetite suppressant shots?
Yes, we've seen kind of a rally in Amgen, and we've seen a rally in Viking. Both of them have GLP-1 drugs in their pipeline. Other companies include Zealand, Altimmune, and Pfizer's also got like an oral GLP-1 as well. So there are several companies developing these GLP-1 drugs for obesity. In terms of what's next in the space, so I think we're going to constantly see this back and forth between Lilly and Novo on the innovation front. So Novo's got Wegovy, Lilly's going to bring in tirzepatide. Novo's then got CagriSema, which is a combination product. And then we've also recently seen, really strong data for retatrutide, which is a triple agonist, unlike tirzepatide, which is a dual agonist. So it's targeting three things instead of two.
All right. So, Mikey, it's really important for you and for healthcare investors to follow where different drugs are in the regulatory pipeline. You guys actually have a model of that, don't you?
Yeah, we have a
tracker.
We have a model on the system. Yeah, we have a tracker on the system.
And it's the best. It's the best on Wall Street by far. Who's the person that manages that again? Who's the person?
Oh, yeah. So Sam and I look at it.
Yeah. All right. It's the best on the street. They track every single.
How do I get to it? BI what? What do I type?
We'll find it. I'll get it for you in a second. But it's just the best. If you're a healthcare geek, you have to have this thing because you have to know where drugs are, when the tests are coming, all that kind of stuff. And the Bloomberg Intelligence guys do that. Mikey Shaw, Senior Industry Analyst, Bloomberg Intelligence. Appreciate getting some time there. Eli Lilly, Novo, both all-time highs here today. Let's get world and national news right now with Dan Schwartzman.
Thanks, Paul and Matt. China has been surpassed by Mexico and Canada as a top goods provider to the U.S. in the first 6 months of this year. The U.S. importing around $203 billion in goods from China. That's about 25% less than the same period last year. Goods from Mexico were up close to 5.5%. China had been the #1 supplier of goods to the U.S. for over a decade, with trade ties reaching a peak last year. Presidential candidate Ron DeSantis shaking up his campaign yet again. Bloomberg's Steve Rappaport with details.
Ron DeSantis replaced his campaign manager in the third major reshuffle of his operation. Janara Peck shifted to a role of chief strategist, the change-up coming weeks after advisors told Peck her job was secure. The DeSantis campaign recently let a third of its staff go to save money amid concerns about the direction of the operation. Polls show the Florida governor in second place for the GOP nomination, but he trails far behind former President Trump. Steve Rappaport, Bloomberg Radio.
Thanks, Steve. Los Angeles city employees have walked off the job for a 24-hour strike alleging unfair labor practices. Those walking off include sanitation workers, lifeguards, as well as traffic officers. In total, over 11,000 workers are striking as their union, SEIU Local 721, says the city has not bargained in good faith while also engaging in labor practices that restrict their employees and their union rights. This strike is just the latest to roil this city. Currently, both Hollywood and television screenwriters as well as actors are on strike as well. The Mega Millions jackpot for tonight's drawing is estimated to be a record $1.55 billion, beating the previous high by almost $20 million. The jackpot, in fact, is the third largest in U.S. lottery history, topped by just two Powerball drawings. One was close to $1.6 billion, the other just over $2 billion. The cash payout option will be around $757 million before tax. Your odds of winning, though, one in about $302 million. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Dan Schwartzman. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 12:40 on Wall Street. We do check markets all day long at Bloomberg. The Dow, the S&P, NASDAQ in the red. Off session lows. 40-point drop right now for the S&P, down by 0.9%. The Dow also lower by 0.9%, down 307 points. We've got NASDAQ down 1.3% for the NASDAQ Composite Index, a drop there of 176 points. Stocks are falling around the world as traders rush into bonds after a raft of news on China, Italy, and the U.S. fan worries about the financial system and the global economy. 10-year yield, 4.01%. 2-year, 4.77%. Spot gold at $19.27 the ounce, down 0.5%. Bitcoin up 1.8%, $29,695 on Bitcoin, while West Texas Intermediate crude now at $82.15 a barrel, up 0.3%. Another concern for investors, the interest rate outlook and the Federal Reserve. Nancy Curtin is a partner at Alvarium Group Operations in London, and she was a guest today right here on Bloomberg Markets in New York.
Look, the Fed will be successful in bringing inflation down. We already see some encouraging signs. Headline inflation, 3%. Remember, it was 9% a year ago, so that's encouraging. There's some sticky bits in core inflation, but we do think the Fed will be successful in bringing inflation down. And looking forward to 2024, which is what we'll start to do a couple of weeks away. September, we'll start to look forward to next year. We think the outlook for a Fed pause, if not pivot, is encouraging for risk assets.
And you can hear more of that conversation on the Bloomberg Tape podcast. You can download it wherever you get your podcasts. Dish Network is proposing to merge with EchoStar, the satellite network operator it once owned, in a stock-for-stock deal. Shares of Dish, they are little changed right now. Actually, Dish is up 7.4%. Shares of EchoStar lower by 1%. Briefly after earnings, we've got UPS lowering its full-year profit forecast. UPS shares down 1.1%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie Pelleton, thank you so much. We appreciate it. Well, it's too bad that Matt Miller left to go prepare for his TV show at 1 p.m. in Wall Street time, because he's going to miss today's C-suite conversation, which is right up his alley. Ryan Lockwood joins us. He's the CFO of CarParts.com. Trades on the NASDAQ. PRTS is the symbol. Company went public back in 2007. They did a secondary offering very adroitly in 2020 when their stock got a nice pop from the pandemic. Ryan, thanks so much for joining us here. Again, I'm looking at your long-term chart, and it just looks like a lot of other pandemic charts where you had this surge in 2020 as people behaviors changed during the pandemic, and then it's been kind of a slow bleed off after we get post-pandemic here. Talk to us how your business kind of changed during that 2020 period, pre that period during the pandemic, and kind of where we are now.
Yeah, so our business, thanks for having me. Our business did change a little bit, but actually a lot of the change came from a new management team that came in 2019. So part of what we did was revitalize the business and focus it more on the customer. We obviously benefited from some of the stimulus and some of the online shopping that came from e-commerce, but combined with that, we changed to a more stock ship model that it provides more value to the customer. We improved the website. So there's a lot of things going on as part of the story.
What are the drivers of your business? Like when I look at your financial model, what are the key drivers that I need to get right?
I think the key drivers for our business, what you're going to see over the next 3 to 5 years, is a combination of reasonable revenue growth combined with operating leverage. So there's a lot of things we can do to improve marketing expense, fulfillment expense, fixed operating leverage, and we've done a lot of improvements over time. They've all been relatively sticky, and we're continuing to drive improvements over the next 3 to 5 years.
All right, so give me a sense of kind of who your customer is and kind of how do they really interact with CarParts.com?
Yeah, so our customer is going to be generally a value-oriented do-it-yourselfer who is relatively sophisticated or looking to do some easy jobs and save some money. Compared to brick-and-mortar stores, we're 50 to 60% cheaper. So if someone's willing to wait 1 or 2 days to get their part online, they can have significant value, and that's especially useful in a time like this.
All right, so how do I, in your business, how do you drive top line demand? Is it just having more stuff, more SKUs that they may need, or is it marketing promotion? How do you drive your top line?
For us, driving top line, there's a lot of value that we provide, high quality parts, but what we're really looking to do is take the stress out of car repair. If you have a car that's out of warranty, that check engine light comes on, there's not really a great resource for people, and that's what we try to do, is provide information, high quality parts, great value pricing, and if you can't put it on yourself, we'll even connect you to a local mechanic. So we're really trying to provide a one-stop shop for customers that takes the stress out of car repair.
So how, it seems like what we understand here in the post-pandemic world, that Detroit says it's going to build fewer cars, so the days of 17.5 million SAR might be over. Maybe it's 15.5 million cars. That means cars got to, I guess, last longer. Used cars, all that kind of stuff. Is that good for your business?
Definitely. I think that's right. When you look at SAR, we had obviously a very lower SAR, kind of coming into this year and part of last year due to interest rates. SAR might come down, but cars definitely have been lasting longer. They're going to continue to last longer. And I think consumers are going to try to drive value by repairing their car, having it last longer. And I think we're a great resource for them.
Talk to us about, I'm not sure if this is part of your business model, but we've seen it in other retail spaces, buy now, pay later. Is that something you guys offer? Is that a driver? How do you think about that?
Yeah, that is a driver. So over the last couple of years, we've seen buy now, pay later actually triple. It was running pretty steady, around 2.5% of revenue for e-commerce. And recently it popped up at the end of Q2, it was running 7.9%. So we have seen a large uptake in that. I think it's a way that consumers are trying to balance the needs, their everyday needs with their car repair needs.
It's funny, you go to the Consumer Electronics Show, and it's really an auto show, with a little bit of technology around it. I mean, I think the auto industry, controls way more than half the space out there in Vegas. How has, the computerization, the increase in technology in automobiles, how does that impacted your business?
There actually hasn't been that much of an impact. What we sell is a lot of the normal everyday items you need to repair your car. So even with a highly electrified vehicle or even an EV like a Tesla, they still have headlights, tail lights, door handles, AC compressors, radiators, all the normal nuts and bolts, as you might call it, that go into a car. Even the most modern of all cars still has those basics.
Okay, so you're not getting into the electronics and that type of stuff. That's something that, an owner would have to go to the dealer or something like that.
That's correct, yeah. And I think those are usually very durable. So the ECU, as you might call it, inside of a car that manages the brains of everything, is very robust. The things that go out for people are the everyday items, like the AC compressor, the window regulator that makes the window go up and down.
So is your competition kind of just my local car dealer in town?
Our local competition is going to be really the brick and mortar, the big brick and mortars you might think about, or maybe a dealership, where I think people that don't know about us might just walk in and pay $300 for a headlight without realizing that they could come to our website, wait 1 or 2 days. We cover 98% of the country in 2-day shipping. They could buy that same part for $135.
So it's interesting. I'm just kind of wondering again, kind of to grow the business. It seems like, can you acquire customers? Can you market and say, hey, you can do this? Like, I'm not a handy person. But if you say, hey, you can install this headlight.
That's exactly right. So we recently just launched a line of YouTube instructional videos, starting with the Ford F-150. It's the nation's most popular car, showing you how to replace a lot of parts on that. We're going to the Dodge Ram, and we also recently launched a Spanish language version of this channel to kind of hit more audiences and make people feel comfortable that they can do these repairs themselves.
That makes sense. All right, Ryan, thanks for taking the time. Appreciate learning a little bit about your company and kind of its expectations and kind of what are the drivers of this company. Ryan Lockwood, he's the CFO, carparts.com. You can check out the stock. It trades on the NASDAQ. PRTS is the ticker to load into your Bloomberg Interactive Brokers, load into your Bloomberg terminal right there. S&P 500, a little bit off the lows, down about 0.9%. The Dow off about 0.8%. NASDAQ off 1.36%. So we're seeing a little bit of a greater sell-off in that tech-heavy NASDAQ. We're going to have more coming up. This is Bloomberg. go to Lisa Matei right now for some company news.
Hey there, Paul. Moody's Investor Service has cut credit ratings for 10 small and mid-sized banks. Bloomberg's Joan Doniger has more on which firms it includes.
M&T Bank and Pinnacle Financial Corporation, but it also names big lenders such as Truist, U.S. Bancorp, and some others as possibly being next. Moody's cites higher costs, potential weaknesses when it comes to the amount of capital the banks put aside, as well as higher risk from commercial real estate loans with weaker demand for office space. Investors have been rattled by the collapse this spring of several regional banks.
And shares of M&T Bank now down more than 2.5%. Italy's right-wing government shocked markets today after imposing a tax on its banks. Bloomberg finance reporter Sonia Cerletti reports from Milan.
This is a tax on extra profits of lenders generated by higher interest rates, which boost the bank's net interest income. Specifically, the Italian government would say that they want to apply a 40% levy on this extra profit on NII.
Merger advisors' bonuses are likely to fall this year, but asset management executives will see modest gains. That's the word from Johnson & Associates. Advisors on M&A transactions could see payouts slump as much as 25%. Traders could see a drop as much as 10%. And AMC Entertainment has Super Mario Brothers movie to thank for its second quarter profit. Analysts had expected a loss, but revenue grew 16%. Those are the company stories we're following this hour. I'm Lisa Mateo, and this is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, Matt Miller and Paul Sweeney here in the Bloomberg Interactive Brokers Studio in New York City, and we're also streaming live on YouTube. You can check that out at youtube.com and just search Bloomberg Global News. S&P 500, we are off 0.9%. The NASDAQ feeling a little bit more on the chin, off 1.3%. Looking at the yield space on the 10-year Treasury, up 30 seconds, pushing the yield down about 7 basis points, 4.02%. The 2-year at 4.77%. So still inverted yield curve, but less than it was in recent months. So some folks call that a yield curve steepening is what I think Ira Jersey characterizes it as. So we'll keep on top of that. Right now, let's go to New York. Dan Schwartzman's got world and national news for us.
Thanks, Paul. Republican presidential candidate Ron DeSantis has shaken up his campaign once again, replacing his campaign manager, Janera Peck, and replacing her with his gubernatorial office chief of staff, James Upmeyer. Just in the last month, the Florida governor has let go over 30 campaign workers in an effort to shore up a campaign that has so far faltered in trying to make up ground against frontrunner former President Trump. Lawyers for Trump, meanwhile, asking the judge overseeing the election conspiracy case to reject a protective order to limit public disclosure of evidence that had been requested by the special counsel. Bloomberg's Nancy Lyons has more from Washington.
Attorneys for the former president say the order would violate Donald Trump's First Amendment rights and is too broad. They asked the judge to only place limits on sensitive materials being disclosed. Former federal prosecutor David Weinstein tells Bloomberg Balance of Power it's now up to the judge overseeing the case. Tanya Chutkin.
She'll draw on her practice and procedure on what is traditionally done within her courtroom, within the district, and she will fashion her own order that incorporates much of probably what the government has asked for.
In Washington, Nancy Lyons, Bloomberg Radio.
Thanks, Nancy. During a speech in Philadelphia, Vice President Kamala Harris announced a change to labor rules that could give raises to construction workers working on federal projects. Harris says the Labor Department has updated the Davis-Bacon Act of 1931 that requires paying workers the prevailing local wages on public works projects. The new rule is likely to raise the wages of more than 1 million construction workers who are currently working on roughly $200 billion worth of federal projects. Critics say the added cost will just make construction projects even more expensive for taxpayers. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Dan Schwartzman, and this is Bloomberg. Paul, back to you.
All right, Dan, thank you so much. We appreciate it. All right, it's only August, but I can tell you, trust me, that our good friends on Wall Street are already thinking about their year-end bonuses, and not surprisingly, that is one of our most read stories on the Bloomberg terminal today. Merger advisors' bonuses, now these are the merger M&A guys, are likely to tumble this year as the business remains stagnant, though asset management executives will see modest gains. That's according to Johnson Associates. Advisors on M&A transactions will probably see payouts slump as much as 25%, and any respite is unlikely until 2024. The compensation consultant said in a report Monday. Traders are also in for a disappointing round of payouts, with incentives dropping as much as 10%. But certain fixed income businesses are likely to outperform, according to the report. Despite the mostly pessimistic assessment elsewhere, wealth management outshines other business segments on new clients and rising capital markets. Bonuses will probably fare better among alternative investment firms, where hedge fund bonuses are trending flat to up modestly. The private equity outlook is little change from last year amid difficult fundraising. That's according to the report. Executives in underwriting should expect bonuses flat to down as much as 10%, though equity underwriting has been gaining momentum, according to the report. So when you think about Wall Street this year, it's been a challenging year. We heard that from some of the big banks reporting so far this year, the first half results, and a lot of those businesses are down. Pipelines are decent, but the actual transactions getting done for most of the banking side are down year over year, certainly down from recent years. So again, you'll see that right in the compensation. Now, the good news for folks on Wall Street is compensation, the year-end bonus, the discretionary, is a lot less a percentage of total compensation than it used to be, but it's still extraordinarily important and makes or break a year. So we'll keep an eye on that for our good friends on Wall Street. Sound On with Joe Matthew. He's down in Washington, D.C. He's got all the politics. He's got all the big guests. That starts right now. the first by a large company. We'll talk to the head of the company's blockchain and digital currencies team.
Plus, the ongoing legal battle over crypto, with the courts splitting over the question of when a digital asset is a security. We'll talk about the issue with Melton Demirs from CoinShares.
And Kathy Wood says the SEC may approve multiple spot Bitcoin ETFs at the same time. We'll talk with Terrence Yang of Swan Bitcoin about where we stand in this race.
All right, so all that is ahead, a lot to look forward to. But first, let's get a snapshot of the market. The best way to do that on your Bloomberg terminal, CRYP Go. And what you will find is a pretty much across-the-board update for digital assets. Bitcoin right now up about 2%. We are trading south of $30,000. We've really been in this 29,000 something range for quite some time. Ether, on the other hand, up about 1.5%. And XRP, of course, the token in focus when it comes to that Ripple SEC ruling from several weeks ago, is actually outperforming today, up more than 3%. What's interesting, Matt, is to see digital assets performing this way, gaining strength at the same time that the broader market is under pressure, with the NASDAQ 100 down about 1.4%.
Yeah, I agree. It's very interesting on such a risk-off day to see crypto soaring. We do see also, very interestingly, the discount to net asset value, which GBTC trades, shrinking. So GBTC, the Grayscale Bitcoin Trust, is getting closer and closer to its net asset value as optimism increases that spot Bitcoin ETF will be approved. So I think this chart is one of the most interesting that I've seen in crypto, especially around this issue, which we've been talking so much about. Let's continue to focus on this here. PayPal has rolled out a stable coin fully backed by U.S. dollar deposits, short-term treasuries, and similar cash equivalents issued by Paxos Trust. PayPal USD will be gradually available to customers in the U.S., according to the firm. Joining us now for more on this, I'm pleased to say, is PayPal's Senior VP of Blockchain, Crypto, and Digital Currencies, Jose Fernandez de Ponte. Jose, thanks so much for joining us. What do you think about the increasing optimism around, I guess, crypto versus regulators?
Hello, Matt, and hello, Kaylee. Thanks for having us. Well, I am an optimist. I would maybe qualify with to say I don't think this is versus regulators. I think it is important that there is clear regulation, and we have seen increased traction there, not only in the U.S. I think that the progress in places like Europe and other regions is important. Clear regulation is something that we absolutely need for digital currencies to go mainstream. So super excited to see things moving forward.
Well, someone else who was very keyed into the regulation issue and was also excited to see this stablecoin announcement from PayPal specifically is the chair of the House Financial Services Committee, Patrick McHenry. He said that this announcement is a clear signal that stablecoins, if issued under a clear regulatory framework, hold promise. Clear regulations and robust consumer protections are essential to enabling stablecoins to achieve their full potential. That was the quote from him. He obviously is trying to get a stablecoin measure pushed through the U.S. Congress, but you didn't even wait for that, Jose. You decided to launch this now. So walk me through the thinking and what the long-term goal here is for PayPal. What are you trying to achieve with this?
Yeah, Kelly, we are obviously a payments company, and we are interested in digital currencies because we do believe that they have the potential to transform the payment ecosystem. If you look at the primitives of the technology in terms of the cost of transactions, in terms of the settlement time, in terms of the programmability of the tokens, you just can do things that you couldn't do with traditional payment rails. And it's something that is strategic for us, and it's something that we want to be a part of. We also think that, by the way, that the revolution will not happen overnight. If you look at the volume of stablecoins today, they're around 120 billion or so that are out there today. Mostly they are using crypto ecosystems and Web3 use cases. And we think that will continue to be the case for some time, with some emergencies in specific verticals in places like remittances or video games. It's absolutely strategic for us. We like the primitives. We like the ability to be able to do things that you couldn't do before in payments. And obviously, it's a strategic technology for us.
Okay, so let's talk about where you're going to be able to access it. Obviously, you're partnering with Paxos for this. Where is Paxos, in conjunction with PayPal, planning to actually list this?
As of yesterday, we are live on the PayPal wallet, and we are ramping up the product now. Over the next days, more and more users will be able to see that in their wallets. We are going to be, as we announced yesterday, we're going to be enabling that in Venmo. We are super excited about the ability that for the first time, you will be able to send value from your Venmo wallet to your friend on PayPal, as opposed to only Venmo to Venmo or PayPal to PayPal. And over time, we will definitely open that up to external parties. We built the stablecoin to be able to be easily accepted by crypto exchanges and the apps and wallets, and we will see more and more of that adoption going forward. It's one of the reasons why we wanted to build this on open protocols and as a ERC20 token, so that it is easier to adopt it in a more open ecosystem.
I'm just wondering why you would want to be first. Aren't you worried about other regulation? And also, how do you expect to generate revenue from this?
So I don't think that we are worried about going first. We have been, we're a regulated financial institution. We have been a regulated financial institution for 25 years, and we take our regulatory relations and structure very, very seriously. We are regulated in multiple geographies. What we are doing here, when we think about the stablecoin, we think of that as an extension of the PayPal balance that you have seen over the years. PayPal balance has existed for more than 20 years. What we are doing now is increasing the value proposition of that PayPal balance and making it useful outside the PayPal constraints. Let's remember also that there are regulations out there. We think one of the reasons we went to New York is that New York has a very solid and rigorous framework for stablecoins, and we think that is very well suited for the business that we're trying to build.
In terms of the interest income that you'll generate from the stablecoin, how do you split that with Paxos? Who gets how much?
Well, the details of the commercial relationship with between Paxos and us, they are obviously private. And we do think historically it has been the way in which the stablecoins get monetized, the yield on the reserve assets, and that will continue to be the case. And it's obviously an interesting aspect of it, and it's a high margin revenue stream. Over time, again, going back to us as a payments company, we are really interested in driving payment flows here that will also be monetized in a number of ways that are beyond just strictly the monetization of the reserve.
As we're talking about payment and the way money moves through the world and who it potentially moves to, there is a lot of concern where I am here in Washington, Jose, about what stablecoins and crypto can enable in terms of money laundering or other illicit activity. Once the token leaves your network, how can you guarantee that doesn't happen on another platform?
So let's go to a combination of two different factors there. First, again, our history in terms of being able to handle, to manage fraud and prevent illegal activity in the network. We have been doing that. We have thousands of colleagues in the company who are very well versed in addressing online fraud and being able to identify suspicious behavior. And the other side, again, is the regulation. So New York has very strict provisions on what you need to be able to do in terms of KYC and AML, and we are compliant with that. Is one of the aspects if you want to be on the regulated fiat stablecoin space, and we will work with regulators and we will work with law enforcement.
Jose, I wonder, about the consumer acceptance of this, or consumer demand maybe for it, because it's expected to make remittances cheaper. You'd expect everybody to gravitate towards it. So what's the take-up been?
So the remittances is one of the places where we think that you will see initial retail acceptance. You see that on remittances and a few others, mostly on fairly specific verticals. We talked about digital goods. We talk about B2B and cross-border commerce. On the remittance side, one of the things that you need to keep in mind when you're thinking about remittances is that the sender, the person in the U.S. who's sending money back home, is acting on behalf of the receiver. So it's important that the experience for the receiver continues to be very seamless. There are flows and remittances going to different countries now for the more sophisticated users. One of the places where we think we will be differential and where we can add value is that we bring that connectivity to that last mile through the business, through the network that we have built over the years. You might remember we acquired a few years ago Shum, which was a pioneer in mobile remittances to many countries. And if we can improve that last mile, so the recipient in country does not need to be concerned about whether this is a stable coin and understand crypto and understand wallets, and they can just do what they did and deposit into a bank account or pick up cash. Solving that last mile problem is one of the places where we can add value, and that will drive adoption in the remittance space.
All right, PayPal's Jose Fernandez de Ponte, thank you so much for joining us. Really appreciate your time. We do, though, need to get to some headlines outside of crypto in regard to the Treasury market. $42 billion worth of 3-year notes just auctioned off by the U.S. Treasury, sold at a yield of 4.398%. The pre-sale when issued yield was 4.416%. Bid to cover of 290. That was the lowest primary dealer award ever at 10.3%. Indirect bidders took down 74%, which is the highest since at least 2003. Direct bidders of 15.7%. You are seeing a bit of a leg lower, back leg lower in the 3-year yield after this at 4.41. The 10-year little change, but it was already down by about 7 basis points on the day. And remember, we still have a 10-year and 30-year auction to get through later this week. Another $61 billion in issuance going to be coming down the line. Yeah. But coming up, we'll get back to the crypto conversation, Matt. Terrence Yang from Swan Bitcoin on the Bitcoin ETF timeline and a growing number of investigations into the DCG.
Also, Melton Demirs joins us on crypto regulation as more traditional investors embrace blockchain technology. They take in, Kaylee, the orange pill.
And, of course, to access all the latest data and news on crypto, check out CRYP Go on the terminal. This is Bloomberg.
When you look at tourism, it's booming, but it also means some of the islands are overcrowded.
Exactly.
Is there something that you can do about that?
Thank you for asking this question, because I want to make sure that, in 5 years from now, we will not have sacrificed, the beauty of our sort of natural environment at the interest of a very rapid growth. So that's why I'm really focusing on sustainable growth. That's why I will always push for quality over quantity. Very strict in terms of standards. We are actually looking at our local and regional sort of planning legislation across the country to make sure that we know exactly what we can build and where we can build it. There are parts of Greece which have reached saturation point, and if we have to place restrictions, we will, in order to protect, especially islands, which are more sensitive.
Studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
I think the SEC, if it's going to approve a Bitcoin ETF, will approve more than one at once. So then, again, because most of these essentially will be the same, and it will come down to marketing.
That was Kathy Wood yesterday, feeling bullish about the Bitcoin ETF applications. Let's bring in Swan Bitcoin Managing Director Terrence Yang to talk a little bit more about that and all things crypto. Terrence, great to have you on the program. Thanks so much for joining us. What do you think about the possibility of the SEC kind of folding, I guess, and allowing a spot Bitcoin ETF?
Great to see you again, Matt.
I'm not sure I would characterize it as the SEC folding so much as there are things happening now in the world where wash trading is being dealt with by the authorities. So if you look at what China's doing with respect to Hobie and with respect to what the BlackRock, Invesco, Fidelity, and many others are doing using Coinbase as a pricing source for the surveillance sharing agreements, I think that they're helping. They're at a point where crypto is getting cleaned up. So the price manipulation and wash trading that has been allegedly been happening to a rather wide extent in Bitcoin is subsiding. The professionals are coming in. I'm super bullish on Bitcoin long term as soon as these are approved, but I'm not sure I'm as optimistic as Kathy or some of the others. Like you guys had an article on BlackRock and Invesco insiders talking about U.S. spot Bitcoin ETFs being approved within 4 to 6 months. I think it might take longer.
All right, so, but you think it's going to happen. And Terrence, what I'm wondering is, do you think that the at least partial loss for the SEC versus Ripple marked a little bit of a turning point in terms of the Gary Gensler's attitude towards crypto? Because previously it seemed like he wanted to crush anything and everything, even related to cryptocurrencies. And now it seems like the courts aren't going to allow that, and they're going to have to, in some ways, allow things.
So there's some element of that. I'm not sure how much, number one. Number two, Judge Rakoff, who is a better-known judge, frankly, for financial kind of services and finance-related cases, he basically called out Judge Torres as being incorrect in saying that secondary sales to U.S. retail of XRP is not a security. He didn't say that directly, but kind of implied that that line of thinking was not really correct. So we'll see what happens. And this could end up where the Second Circuit, which is the appellate court for both judges, they decide ultimately what's correct and not correct. I would say that Judge Rakoff's interpretation is down the middle for judges and case law. If you look at the Howey test and all the cases that came after that.
Okay, so whether it is on this specific issue, whether or not the SEC has actually gotten knocked down a peg in terms of what it is able to call a security and what it is not, or it's this question around the spot Bitcoin ETF, Terrence, I just wonder how much is baked into the market at this point. If those things that in theory would be good news are already priced in and we're at risk of downside, or if it's more risk of upside should we see approval of an ETF, for example.
Sure. So as soon as it's approved, which could be as long as several months to up to 2 years, I would say, on the outlier, maybe 18 months. 4 to 6 months feels aggressive, but Bitcoin is severely underpriced given its asymmetric upside and given the rush of cash that's going to flood in to BlackRock, Fidelity, Invesco, and all the other spot Bitcoin ETFs. That doesn't mean that Bitcoin can't crash in the shorter term because of all that's happening with respect to Binance and Coinbase and Terra and Hobie. So I think there's a lot of things happening, and it's very hard to predict, as usual, the price of Bitcoin short term. Bitcoin is one of those assets, for better or worse, that's highly volatile in the short term, but long term, its trajectory is unparalleled because it's censor resistant, confiscation resistant, and has a credibly immutable fixed supply of 21 million Bitcoins.
All right, Terrence, we have to leave it on that note, but thank you very much for joining us today. That's Terrence Yang of Swan Bitcoin. We appreciate your time. And coming up, we have more conversations ahead. Melton Demirs on institutional adoption and more on regulatory hurdles for the industry. This is Bloomberg.
everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about like how long does it solve things, a lot of it starts with, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
From New York City,
From London and Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Good evening. Here's what I'm watching.
You do not want to miss this
He is
story.
there to kind of upside.
The SEC probably appeals. I think it was a huge victory. And it's a victory mostly in that, forget who was right or who was wrong. Gary Gensler at the SEC has been saying over and over, the rules are clear. Just follow the rules. And we had a federal judge that said the rules are nothing close to clear. But our stance, Mike Novogratz' Galaxy's and the whole industry stance has been, help us get clear rules, because they're not clear.
That was Galaxy Digital CEO Mike Novogratz speaking with Carlyle Group's David Rubenstein. You can catch that full interview on Bloomberg Wealth tonight at 9 p.m. Eastern Time. But as we just discussed, more traditional financial firms are adopting crypto tools, but the uncertainty remains after one judge contradicted the Ripple ruling from a few weeks ago about labeling digital tokens securities. So let's bring in CoinShares Head of Strategy, Meltem Demirs, for more. Meltem, we were just speaking with Terrence Yang of Swan Bitcoin about this. He was saying that he isn't as optimistic about a spot ETF approval as some of the market seems to be. Also was pointing to this kind of discrepancy in these two rulings. So what's your read really on the progress that has actually been made here?
I think that we continue to be locked in a pattern that, frankly, we've been locked in since the start of regulation of crypto or attempts to regulate crypto, which is we see one position from the SEC, which is regulation by enforcement. Nowhere has it really been established what assets are considered securities and which are not. And even in the two Ripple rulings we've seen, which were not even a month apart, we have dramatically different interpretations. And again, the conclusion we come to, and I think in that clip you just showed from Mike Novogratz, who says the exact same thing, the only way that we get clarity is not through these piecemeal regulation by enforcement steps we've seen, but through clear regulatory guidance. And that, in my view, at this stage can only come from Congress. Now, you're in the slump. You know we're coming up on a shutdown. We're coming up on an election year. There are a number of bills on the floor in Congress that are bipartisan in nature, but the clock is really running out in terms of timeline to get these things through the process.
How should the community react, or how should the community act, I guess, if we don't get clear and concise regulation from Congress? Because that seems like a really big ask, Meltem.
It is a big ask. It has been a big ask. It continues to be a big ask. I think there are two important things to keep in mind here. Number one, crypto has gone from being a small, aligned community to being a global industry with different perspectives. And frankly, companies and projects in the space might have somewhat different goals. As a result, we've seen a number of different PACs and different trade associations forming, attempting to gather resources to use their collective power to lobby and to deploy capital to getting candidates elected that are going to take action, that share their perspectives maybe on the direction that regulation and policy needs to go. So I think crypto is becoming a political powerhouse. It is an important part of the DC ecosystem. And I think in this cycle, we'll continue to see a lot of campaign contributions going from players in the crypto space, crypto-specific PACs to specific candidates. And number two, I think at a certain point, right, we cannot continue this stalemate. At the end of the day, this is an important geopolitical issue as well. We see strides being made in other parts of the world that do have thorough guidance. We see economic activity flowing there. So at some point, I do think this becomes a matter of national interest, a matter of economic interest to ensure that America remains competitive.
Melton, we only have about a minute left, but you just mentioned the stalemate in terms of policy. It also feels like we're at a little bit of a stalemate in terms of actual activity in crypto markets. What are you seeing?
Apathy, we're trading sideways. At the end of the day, what we look at CoinShares is flows. If we look at flows into crypto products that are publicly listed and publicly traded this year, as of about 2 weeks ago, we saw about $750 million of inflows on the year. Over the last 2 weeks, we've seen outflows as a result of investors taking profit. And really, we're still very much in a risk-off environment. At the end of the day, the story is all about flows. You have to look at the data. You have to look at the numbers. And right now, the flows are telling the story that investors are taking risk off the table. We're looking to see what's going to happen in the next FOMC meeting and what the macro environment looks like ahead. And I think only then will we see more flows.
All right, apathy, the word of the day. Thank you so much, CoinShares' Melton Demirs. Appreciate you joining us. And coming up next week, we'll be speaking to the Bit Digital CEO, Sam Tabar. So don't miss that Tuesday, 1 p.m. right here on Bloomberg.
From the world of politics
We're not going to be relying upon countries whose values we don't share.
to the world of business.
It's all about corporate power of the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time? Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern
It's the one area, really, of bipartisanship.
I think we're getting more of it.
That's optimistic.
and Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee
The
Limes.
door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue. He's no longer trying to run away from
That
it.
really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most. It's not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure. With two more potentially to come. I'm willing to have this battle.
It is vitally important. This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader.
Yeah.
And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Access the financial world on demand.
Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is Bloomberg Markets. I'm John Ehrlichman.
And I'm Matt Miller. Let's get a quick check on what's going on in the markets on this Tuesday. We're seeing declines across the indexes. The S&P 500 down right now a little more than 0.8%, so trading at 44.80, under the 4,500 level. Investors are seeking the safety of 10-year treasuries, buying those bonds, and that pushes the yield down a little bit further. Right now, 6.5 basis points or so to 4.0220. We're also seeing the U.S. dollar continue to strengthen, and it has been on a bit of a tear lately, now at 12.31, 12.32, so continues to gain weight here against other currencies. And NYMEX crude, although it's up 43 cents at the moment, it has been up and down today. Right now we're looking at $82.36 a barrel for West Texas Intermediate crude. John, what are you looking at?
Well, certainly some of those energy stocks with crude on the move, but we do have these other macro stories that we've been tracking today. Obviously, the Moody's downgrade of some regional banks. We'll talk more about that coming up. But, for example, M&T Bank shares right now down about 2.5%. You've also got this overarching theme from UPS about volumes right now being weaker, and that raises concerns about the economy, although UPS shares are managing relatively well. They're off about 0.5% today. And then some very stock-specific stories. Just wanted to remind our audience, Matt, Eli Lilly, the potential for their weight loss treatment and the early sales picture there, getting people excited. Stock right now 13%. And then going in the other direction, we've got Beyond Meat still down about 15% on the day. The reality, perhaps, the economy, the inflation story, people making decisions on what they want to pay for, and maybe a little less on the plant-based protein products right now. At least that seems to be the message from Beyond Meat.
All right, very interesting stuff indeed. We have a reporter roundtable on the big headlines of the day. Mike McKee joins us on yields and the recent Treasury auction, Sonali Basak on Moody's downgrades, and Ed Ludlow on automotive earnings. Mike, let's start with you and talk about, we just saw a 3-year auction. We're going to get 10s and 30s later this week. I think over $100 billion worth of auctions. How did today's go, and what are we expecting to come?
Well, Janet Yellen and company at the Treasury got good news today, Matt, because there was a lot of demand for the 3-year note. Treasury has upped the auction sizes for the first time in over a year, and so there was some question about how this would play out, given how much debt the U.S. is putting forth. But we get a nice stop-through on the 3-year note yield issued at 4.398. That's lower than last month's auction, 4.416. Or lower than the when issued. I'm sorry, not last year's auction. Primary dealers take down a record low of 10.3%, while indirect bidders take down a record high of 74%. So a lot of people out there wanting to own these 3-year treasuries. Direct award is at 15.7%, and the bid to cover ratio goes up 2.9%.
Very cool. Indirect bidders, the highest since 2003, I believe. Michael McKee, thanks so much for joining us. Let's get to our Wall Street beat. U.S. bank stocks are down after Moody's downgraded ratings for 10 small and mid-sized banks. PGIM's Michael Collins reacted earlier, staying positive on the group.
One of our biggest overweights in our portfolios are the big money center banks, which have been heavily regulated. Now the big super regional banks are going to be a little more tightly regulated, and that actually is a tailwind for bond investors. So if these things underperform, if their credit spreads widen, we're typically stepping in and buying them.
Sonali Basak is here with more. Sonali, I guess big news. One of the questions I've been hearing today, why now?
Yeah, well, we know that these ratings reviews always come at a big delay to what is actually happening, and they say as much, except for they look at these longer-term pictures here, too, for the banks. I think, interestingly, for PGIM, very importantly, a lot of these notes from Moody's had said that the capital picture, when you look at the new rules being put out by regulators, will be net positive for a lot of these banks, which is reflected in PGIM's view here. However, you see the market reacting pretty strongly to the news of the day, and it makes sense because once you are downgraded, it certainly has an effect in terms of counterparty risk that is being taken on. So what exactly happened? You have 10 banks that were downgraded, including M&T, which is more than $200 billion in assets, but then you also have a group that is in review for downgrade and another 11 that have negative outlooks. And so that uncertainty is sending every bank in the KBW Bank Index down on the day. The entire index is down about 14% on the year. So it is the news that the banking system didn't need, on top of all these structural headwinds that have been there for a while that Moody's is noting. I will also note some of these issues are idiosyncratic. I think one very interesting part of this is U.S. Bancorps, because if you look at Moody's note here, they cite an acquisition of another bank, lowering their capital relative to their rivals. And if you think about the future M&A we could see in the industry, that kind of an action, you have to wonder whether it will make people think twice and if it has any impact in terms of future deals and capital levels faced by the industry.
Shonali, that's where I was going to go, because if you've got a situation here where there's lingering concerns about real estate exposure or funding costs or regulatory headaches, and ultimately regionals have to pay more for their deposits, inevitably, I would imagine there's going to be consistent questions about what their business looks for in the face of having to pay more for those deposits.
I've been thinking a lot about how to push the story forward here, because when you think about the commercial real estate portfolios and some of the issues that these banks are facing, one early answer has been pushing a lot of this activity toward the private markets. And you've seen private market participants come in and buy assets from these regional banks, cooling some of the pressure with some of these loan books that they're worried about. Another fun thing that's happening at the side here is that a lot of ratings are coming out not about the banks, but about the non-banks and the BDCs. And you're seeing a lot of them being rated BBB. So you're not seeing those same types of, or different types of worries rather in the non-banks. You're kind of seeing everyone being treated relatively equally here when you look at the kind of risks they're taking on in loan markets. So then that market pushback, John, you have to wonder how much lending really contracts from here with these further pressures.
All right, well, I know you've got some continued questions you're going to be asking, Shonali. Thanks very much for breaking it down for us, Shonali Bossack. Meanwhile, we also have some electric car maker news moving as earnings continue to roll in. Lucid shares higher. Rivian rising. We're waiting for some numbers from that company. Tesla also in the headlines this week after an executive shakeup. Let's bring in Bloomberg Technologies' Ed Ludlow, who has been tracking all of this. And Ed, I guess maybe we start with the Lucid story, where you have just this this sort of trust me messaging from the company on meeting those production numbers for the year. But the bigger question of, can this be truly a competitor to the likes of Tesla, which was the big hope?
Yeah, exactly so. The share's up now, and you wonder how much of that is a relief rally type response. The commentary from Peter Rawlinson, the CEO, is that they will build more than 10,000 electric vehicle units this year. But remember, that's at the bottom of the previously guided range, 10 to 14,000. And even then, they had previously said that they were guiding to the lower end of that range. So it's kind of a low bar, but there is a sense of relief. This is, frankly, a company that is losing more than $500,000 per vehicle that it builds. And the story with Lucid has been one of them talking about superior battery technology, the energy density of their packs being higher and higher performance and efficiency, but they've not been able to achieve scale where the financials make sense and they can have economy of scale. The other key piece of news was that basically a letter of understanding or a letter of intent intent from the Saudi government to buy 100,000 EVs from them over a 10-year period has now become a full commercial agreement, though there are some caveats within that. So we're still waiting on them to kind of get going on this and ramp production, and there was an acknowledgement from Rawlinson that they've got work to do to find customers because their vehicles have been at the very high end and they've had to cut prices in pockets as a response.
Yeah, very expensive, but you can get over 1,000 horsepower in those vehicles. Rivian comes close, I think 850 or thereabouts horsepower with the quad motor setup. They're coming out with earnings tonight. What should we expect, Ed?
Yeah, it's interesting. They continue to stick with their guidance for 50,000 units this year, which is split across the two consumer EVs, the pickup, which you see on your screen, an SUV, and also the delivery van they make for Amazon. In an interview a few weeks ago, the CEO, RJ Scaringe, told me that Amazon's vans are roughly 20% of output, but lots in the street have wondered how conservative that guide is, because on paper, the plant in Illinois is worth more. Two specific things to look for. One is cash burn. It's possible that the operating loss has expanded to $1.56 billion. We wanted to see the operating loss narrow. The second thing is that at $80,000, the SUV cannot be eligible for the federal tax credit. So there are questions actually about how much traction these, exactly. It's all well and good having a wait list and a number of pre-orders, which they no longer disclose, by the way. But finding new customers at that price point is hard, and we know that because Tesla and Ford had to cut prices on vehicles that are a much lower price point than that.
Yeah, what a fascinating sector and time for the automakers. Ed, thanks very much. Ed Ludlow covers the EV makers for us off the West Coast. Coming up, Josh Kobza joins us to discuss the state of the restaurant industry after sales for Popeyes and Burger King were nearly double Wall Street's expectations. This is Bloomberg.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers Jobs Day like Bloomberg. Welcome to the world of decentralized finance. Bloomberg's covering all things crypto, the people, the transactions, and the technology. Bloomberg Crypto, only on Bloomberg TV and radio.
This is Bloomberg Markets. I'm John Olipin with Matt Miller. Time now for our stock of the hour. Restaurant brands higher today. This is the home of brands like Burger King, Tim Hortons, Popeyes Chicken. Even with cautious consumers, Burger King benefiting in particular, Matt, from a couple of things they have focused on, including remodeling their stores and introducing some catchier ads.
Yeah, very interesting stuff, and especially in light of the chicken news that Tyson was trading down on yesterday. What's bad for the producer may be good for the distributor. RBI CEO Josh Kobza joins us now to talk a little bit about this. And Josh, great to have you on the program. Thanks so much for joining us. We all love that chicken, but prices are dropping. What's the story in the sector?
Yeah, Matt, John, thanks so much for having me on the show. It's a pleasure. We all love that chicken from Popeyes, and the Popeyes business has been doing really well. We had a good quarter where we grew all over the world with Popeyes, and we also grew about 4% on our same-store sales here in the U.S. We had some really fun new news. A lot of it came out of the kitchen that's right behind me. We launched things like ghost pepper wings, a mango lemonade, and a delicious strawberry biscuit this quarter. So we made a lot of guests happy and had pretty good results as well.
So that's part of the chicken story, but we know that if you look at both your Tim Hortons business and in particular the Burger King business, that there has been some momentum there. You had this campaign, Reclaim the Flame. This is not just advertising. This is very much a big investment in the business, in technology, in what the stores look like. How confident do you feel about narrowing the gap with your rivals through those investments to date?
Yeah, John, as you mentioned, there were probably two big highlights from the quarter for us. Our Tim Hortons business in Canada had a terrific quarter. Our same-store sales were up over 12%. That's a really remarkable thing, and it came from exactly what we're focused on, of growing PM food and growing our cold beverages. We also had a really great quarter at Burger King in the U.S. As you mentioned, we launched the Reclaim the Flame plan. That was about a year ago, so Tom Curtis and his team, Tom runs the business here at Burger King. They've been doing a really nice job. We've been working on investing about $400 million to revitalize the brand. We're doing that alongside our franchisees. And we're investing in a combination of more advertising and improved facilities. So we're doing more ads. You've probably seen a lot of our Whopper ads on TV, and that's great. But we're also reinvesting in the facilities, upgrading things like technology, upgrading the equipment in the restaurants, and remodeling some of our restaurants that are a little bit more dated. So, it's we have a long road ahead, but we're really pleased with the progress so far.
How much are the raw materials costs affecting your bottom line, Josh? Because we see, as I mentioned at the top, a chicken glut, at least in this country, bringing prices down. On the other hand, the cattle supply is tight right now, right? So beef prices are high. How is this all affecting the money you make?
Matt, it's a great question. And I would tell you, last year we saw a bit more inflation on a lot of the inputs in our business, and that started to moderate a bit more this year. So it's a little bit different across each business segment, but we have seen a bit of moderation this year, and our outlook for the full year is to see some more moderation in those input costs. And that's one of the things, combined with the really strong same-store sales, that's allowed us to increase our franchisees' profitability. That's really the lifeblood of a restaurant business, is the earnings of the franchisees at the restaurants. It's been a big focus of ours to make sure that we improve the restaurant results, because that's what allows our franchisees to reinvest, to staff the restaurants properly, to reinvest in the restaurants, and to remodel the restaurants. So we're pretty pleased with the results we're seeing in franchisee profitability this year.
Those are the franchisees. For you, what are the biggest costs? I mean, does it have anything to do with meat prices? Is it more of a labor issue? What are you focused on?
Yeah, I would tell you, we're really focused on growing our businesses all around the world. The things that we're looking at spending money on are big investments that we think can really drive our business and our franchisees' business together around the world. So we're investing in things like the facilities, where we want to upgrade and have really modern, beautiful facilities like the kitchen you see behind me here. And those are some of the big investment items that we're really focused on to drive the business forward together.
Hey, Josh, thanks for the time today. Good to see you. Restaurant Brand CEO Josh Kobza joining us with a breakdown of the quarter coming up. Nancy Tengler joins us to talk about market moves and her firm's new exchange-traded fund. This is Bloomberg.
climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. You know, we're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China. Nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority.
This is Bloomberg Markets. I'm John Oakman with Matt Miller, and let's get a quick check on what's happening with the markets right now, Matt, on a day where you've got global concerns. We had that worry about the demand story coming out of China. You have in Europe questions around taxation of company profits. And then, of course, Matt, we've been talking about the story of banks, regional banks in particular, which Sonali Basak was telling us about, and Moody's decision to downgrade some of them. And so right now we're looking at the S&P 500 off about 0.8%. For more on the markets, we're joined by Laffer Tengler Investments CEO and CIO Nancy Tengler, whose firm just launched an equity ETF today, which we'd love to get some perspective on, Nancy. But I guess, you know, for those who are trying to figure out if we are at some kind of inflection point for the markets after a very strong start to the year, what's been your assessment?
Yeah, well, I do think we needed to take a breather, John. You know, the market ran pretty hard and fast since January and even since October. And so we had been saying since June that we thought we just needed a correction. We had a little brief sell-off in early July. And then this looks like a market that was ready for some bad news to take advantage of. I think the bank downgrade is a little late, and the new regulations on the big banks, to me, all smack of, hey, how about we just implement the regulations we had in place, which were not being implemented or at least enforced with Silicon Valley Bank on the West Coast, and let's step back and take a look. So we're just making everything that much harder for businesses, which we're really starting to pull out of the sort of malaise of last year.
I think what's challenging at a time like this as well is, especially when you have these new themes in technology, which fueled a handful of stocks in a big way this year. People look at those run-ups and they wonder whether those names start to hit any speed bumps. I mean, even in your ETF, you're focusing on a long term that might play into technology because of some of the realities with the economy, including a tight labor market.
Right, exactly. So if you go back and look, historically, when we've had tight labor markets, spending on technology has risen pretty dramatically as a percent of GDP, and then that has worked its way through to the underlying stocks. So our theme in the TGLR is old economy companies that are embracing the digital revolution. So think of a name like Pepsi that said, we're a technology company that just happens to sell snacks and beverages, and then the suppliers of those solutions. So the technology names, the chip companies, the software, cloud computing companies that we can own, the ones that pay a dividend, we own in this strategy. And I think the important thing is these are companies that are growing their dividends. This is not an electric utility portfolio. It's companies that are focused on dividend growth and management teams who are setting the dividend as a portion of what they think long-term sustainable earnings power is.
You know, Nancy, I spoke earlier with Margie Patel over at Allspring, and she likes big big tech companies right now, both for their growth potential and in some ways as a safe haven. And you've seen that in the market all year long. Do you see that as well, that some of these companies can give you dividends that you hope, they'll either hold or raise, and also be kind of safe haven companies in case of a recession?
Yeah, absolutely. What you want to own when you go into a slower growth environment, Matt, is companies that can deliver reliable earnings growth. We were saying last fall that we were adding risk back into our portfolio. So it was technology, and we were adding some new consumer discretionary names. And that has worked out very nicely. We've been trimming back almost every technology name in the portfolio, but we're still overweight tech. And that is in these large dividend payers. So think growers and payers. Think Broadcom, think Oracle, Microsoft. Even though the yield is low, they've been pretty decent about growth. It's about 10% annually. We added NXPI Semi not so long ago, and it's got about a 3% yield and strong dividend growth. So those are the places where you do want to hide in a slowing growth environment. I know it's traditional to think staples, but we've also added to short cycle industrials as the manufacturing PMIs are starting to bottom and work their way out. So you're absolutely right. It is not only a growth play, but a safe haven play.
I want to just quickly ask about costs. You have 95 basis points as your expense ratio, and I know you want to get that down on your ETF. TGLR is the ticker. How do you keep costs down in an active ETF like that?
Well, we need to grow it, obviously, and then that gives you a lot of flexibility. Growth solves a lot of problems. But we are in general, even in our wealth business, our high net worth business, our fees are very competitive. And I write about this in my book because fees are the biggest eroder of total return. You have to pay to get good management, right, but we're very conscious of that. And so we're always reassessing how we can cut costs at our firm and then how we can pass that along.
Nancy, thanks so much for joining us. Really appreciate your time today. Laffer Tangler, Investment CEO and CIO. Nancy Tangler. For John Ehrlichman, I'm Matt Miller. This is Bloomberg.
Everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about how long does it solve things, a lot of it starts with, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
Breakout we have all perhaps long awaited, finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto. The people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Out of stocks and back into bonds. Live from Studio 2 at Bloomberg headquarters in New York, I'm Romaine Bostic.
And I'm Katie Greifeld, kicking you off to the closing bell here in the U.S. It's a much different dynamic than what we were looking at 24 hours ago. You're looking at an S&P 500 off by about 0.8%, had been down by over 1%, but clearly still deeply in the red. You look at the NASDAQ 100, big tech really taking the brunt of the selling pressure today. The NASDAQ 100 off by 1.2%, and a bid, as Romaine mentioned, into bonds. You look at the 10-year Treasury yield above 4%. It actually broke below that level earlier, currently down by about 7 basis points. Of course, we got some disappointing trade figures out of China overnight. We got that Moody's downgrades of 10 mid-size and small lenders, maybe more to come. You take a look at the dollar, seeing a little bit of a haven bid, Romaine. The Bloomberg Dollar Index up by about 0.4%.
Yeah, let's stack it all together here because investor sentiment was certainly weak coming into today, and that was on the back of the China data that Katie just mentioned there. Exports plunging the most since early 2020, the start of the pandemic. That pushed commodity prices down for a second day. Copper, in fact, which we remember rallied 6% in July, erasing all of those gains and then some. The MSCI Emerging Market Index breaching that 50-day moving average to the downside and coming about 1 point away from crashing through that psychologically important 1,000 threshold. Something to keep an eye on considering the downdraft that we had seen early this year never had been recouped here. Now, of course, all that came amid some of the downgrades that we saw by Moody's. 10 small and mid-sized banks getting downgraded. 10 downgrades that also came with warnings that as many as 17 other banks could face negative ratings action. A reminder once again that the fallout from the March swoon of those regional bank stocks still has not fully run the course. And that's causing a big rethink out there of soft landings, Goldilocks, whatever other euphemism out there for clear skies ahead that had become the dominant market narrative. And that really brings us back to the risk-off rotation out of equities writ large and back into the relative safety of treasuries, Katie. Downward pressure on global bond yields, and maybe some of that actually being exacerbated by what's going to be a huge deluge of treasury supply this week.
A big wave of treasury auctions. We got the first today at 1 p.m., that 3-year, $42 billion offering. We actually saw some pretty strong demand. The auction stopped through by that important metric. Of course, the big ones to keep an eye on are coming tomorrow and the day after. Wednesday and Thursday, we get 10-year, and then we get the 30-year auction. Going to be very important, especially after that surprise announcement last week from the Treasury that those auction sizes were going to be bigger than most had forecast. Of course, the reason we care so much is what this means for the long end of the curve and what that means for the inversion of those yield curves that we've been watching over the past couple of years. Really been inverted for quite a while here. You can see that the 5s, 30s curve has already uninverted. You take a look at the 2s, 10s, and the 2s, 30s. Not quite there, still deeply negative, double digit in terms of basis points, but clearly just in the past month or so, that dynamic has shifted meaningfully, Romaine, and we're looking at a re-steepening.
Yeah, starting to see that re-steepening go. Jay Berry joining us right now, co-head of U.S. Rate Strategy over at J.P. Morgan. And Jay, let's start with the re-steepening of key parts of the curve here and whether there's anything out there that you see that could actually slow that or even reverse it.
Yeah, you know, Romaine, first, thanks for having me this afternoon. But we think we're probably at the end of the Fed tightening cycle. And if that's the case, you know, Chair Powell talked about 5 data points that were key between the July and September meetings. We're through 2 of them so far, which seem to be supportive of the Fed on hold, and we think the CPI report later this week will be. If that's the case and the Fed goes on hold, that is typically supportive of steepening, particularly at the long end of the yield curve, because that's the part of the curve that really tends to move first when the Fed goes on hold. Separate from that, you know, we think that the QT process is important as well. The chair in his press conference a couple of weeks ago talked about normalizing the balance sheet, even as he potentially normalizes rates next year, because the balance sheet's too big. And the reason that matters is because the Fed share of the Treasury market matters for the curve slope as well. And as that unwinds, that should steepen the yield curve as well.
Oh, how much do economic conditions play into that, or at least the perception as to where economic conditions will go?
I think it's certainly going to be a very key factor as well, because if we get a sense that labor markets are slowing from where they were earlier this year, inflation's moderating, even though it may be a Goldilocks sort of story, and we're not forecasting a recession at JP Morgan anymore, then it's very possible that supports the Fed going on hold, which would overall support some re-steepening of the yield curve, but not necessarily a disinversion at the front end.
So it's interesting to hear you say that, because you also wrote in a note, and I believe it was this week, that it's more compelling to add duration right now. But if you've scrapped your recession call and you think that maybe the curve will re-steepen a little bit, walk me through that.
Yeah, so it's a very tactical call, Katie, and I think a couple of things driving it. The first is, for the better part of the last 5 months since the regional bank flare-up, the Treasury market has been displaying a pretty large premium on the order of 15 to 20 basis points. With the bearish steepening that we had last week, that sort of unwound, and at least in our valuation framework, we're back to fair value for the first time since March. Second, we talk about being at the end of the Fed cycle and potentially how that is supportive of lower yields. It seems like our investor franchise has been positioned for it for many months, and the overweight in duration can be a contrarian signal for what happens to yields in the weeks ensuing that. So more recently, our own Treasury client survey has come back to more neutral levels, and that is not necessarily the same sort of headwind to lower rates than it's been in the past. So if we think the Fed's on hold, we think CPI this week is supportive of that. That, for the time being, is supportive, we think, of lower yields.
And I want to get into a part of the duration curve that we don't often talk about, which is the 20-year. And one of the reasons we don't talk about it is because it seems like no one really likes 20-year treasuries for whatever reason. I was just looking at it before the show. Well, maybe you should buy them, because right now they're yielding 15 basis points more than 30-year treasuries. Why has that dynamic persisted, basically since we've seen this issue be reintroduced in 2020? And will we ever see that collapse?
You're right. The 20-year sector has been a flashpoint for people since the bond was resurrected about 3.5 years ago. And I think in part because investors have been burned in the 20-year sector. So when Treasury rolled the 20-year back out in 2020, it sort of disregarded the advice from the primary dealer and from the TBAC and from the investor community on how large the 20-year should be sized. And because of that, it underperformed along the yield curve and has been sort of chronically cheap relative to the rest of the long end. It's been right-sized since, and we actually think it's probably right where it's supposed to be right now relative to the slope of the long end of the curve. But if the Fed's on hold here, it's the peak of the yield curve at the long end and is probably going to be well supported, particularly because even as these increased auction sizes that you talked about go on, the Treasury will be increasing the 20-year size by less than its counterparts along the rest of the curve.
So tactically, does it make sense in the same way you're tactically along the 5-year here? Does it tactically make sense to focus on the 20-year?
I think it could. I feel more comfortable shorter in the curve, where I've got more sensitivity to what the Fed's doing and less sort of sensitivity to idiosyncratic demand factors. But for a tactical trade in the supply dynamics that we're talking about, that could make sense, yes.
Well, then what does that sort of portend, I think, for some of the auctions that we get later this week, tomorrow, and of course on Thursday? I mean, the 3-year, we're still talking roughly short end here, but we saw the dealers basically drop out. Indirect bidders did come up. Are you going to see a similar dynamic or with longer duration?
I think the strength of today's auction was because front-end yields are still sitting near their cycle highs. Yeah. And that strength of end-user demand is more about real investor demand than the absence of the dealers. The rest of the week, it might be more sort of a dealer story. And I think that's part of the reason why even in the rally today, Romaine, if it's been driven by weak growth stories globally and the bank downgrades, that the U.S. has actually underperformed their developed market counterparts because we do have this supply to underwrite. So it's an effective global concession to sort of underwrite this supply for the balance of the week.
And before we let you go, I want to return to a point you made about quantitative tightening, and that matters because most of our conversations are around rate hikes. When we look into next year, could we see a situation where maybe the Fed is trying to return to neutral on the rate level but still winding down the balance sheet?
We think that's absolutely the case for a couple of reasons. First, even as inflation moderates, because we're not forecasting an actual contraction in the economy, we think the Fed will be lowering rates in the third quarter and onward, but basically to normalize rates back to neutral. And if that's the case, we think it can continue to normalize the balance sheet because the balance sheet right now is still much larger than it was pre-COVID and much larger as a share of the economy than it was pre-COVID as well. So in our modal forecasts, even though the Fed's easing in the second half of next year, we've got QT going on throughout 2024.
Jay, always great to talk to you, and thanks for putting up with Katie's questions about the 20-year. Jay Berry there, co-head of U.S. Rate Strategy over at J.P. Morgan, helping to kick us off to the close here on this Tuesday afternoon. To look up ahead here on the state of the banking sector after that downgrade by Moody's. Dick Beauvais going to be stopping by over at Odeon Capital in just a second.
Plus, fintech company Broadridge Financial Solutions tops estimate for adjusted earnings and raises its dividends. We'll speak with CEO Tim Gokey.
And a strike averted for UPS, but the damage done to their earnings, lowering its full-year profit forecast and saying it plans to cut management jobs. Jonathan Chappelle, who covers UPS for Evercore, going to be stopping by the program a little bit later. All that and more coming up in a bit. This is Bloomberg.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
U.S. bank stocks roiled a little bit earlier by that downgrade by Moody's, but so too were European bank stocks, particularly in Italy. This is after a provision was slipped into legislation over there that would effectively raise the taxes that these banks over in Italy have to pay. Now, the latest headline crossing the wire is Italy clarifying that that bank tax can't exceed 0.1% of assets. So this was the main concern here, Katie, coming into today, not just that that bank tax was there, but exactly how much it would be, and now learning that there will be a cap of 0.1% of assets. Once again, this only applies, of course, to banks in Italy.
Yeah, just one of several stories around the global banks that we are following today. Let's turn stateside because bank stocks leading losses today after Moody's downgraded 10 small and mid-sized American lenders and warned that it may do the same with a handful of major firms. Joining us now, I'm thrilled to say we have Dick Beauvais. He is Chief Financial Strategist over at Odeon Capital. He covers M&T, which was among the banks downgraded today by Moody's, as well as several of those banks facing potential downgrades or outlook shifts. We're talking about U.S. Bancorp, Truist, PNC, and Ally Financial. Dick, great to have you with us. Let's set the scene here. Were you surprised to see this ratings action?
No, I actually think it came a little bit late. I think that when the second quarter earnings came out, it was evident that the banking industry was suffering. And the reason why it was suffering is because basically as interest rates go up, and this sounds stupid to say, the value of financial assets go down. And if you took a look at the balance sheet of each one of these banks, the value of their financial assets were going down very, very sharply. That meant that the industry was in trouble. It was in trouble on one side because the higher interest rates were allowing the Fed, among other money market funds, to take deposits out of the banks, and there were trouble on the other side because basically the value of their assets were going down. So the fact that Moody had to wait till now to do something was surprising to me. They should have reacted sooner.
And it looks like we're learning just how pernicious that narrative is when it comes to some of these small lenders. Given that backdrop, I mean, so far it looks like 6 firms are facing potential cuts from here. Are you viewing that as more than a possibility, more of maybe a certainty?
Yeah, no, I think, I believe that the banks, understanding what their dilemma was a few months ago, started to reshape their businesses. They began to understand that it made no sense to expand the size of their companies because to do so meant that they would have to pay even higher costs for deposits, and they didn't have the money to do that, number one. The second thing it meant was that those deposits would go into loans. If they went into loans, then the government was going to ask them for even higher amounts of equity. So for the rational banker, the only answer was to reduce the size of your bank. And I think M&T is actually following that policy. I think that Truist and U.S. Bancorp made this acquisition, so you would argue that they're not. But Truist, I think, understands that. I think, one that you didn't mention, Fifth Third, which was also on their list, I think they're moving toward reducing the size of their balance sheet. So now you've got a problem. Because if all of these banks understand that it's in their best interest to let the deposits flow out, to make fewer loans, to put what free cash they have into federal funds where they can get 5.25%, then all of a sudden the loans have got to be made by non-banks. So what you've done, or what the government, you haven't done it, but what the government has done, if they go through with this, is they're forcing more financial risk into the system. Because the non-banks are not audited. The banks are audited. So these loans that will now float over to the non-bank side, because I think the banks are not going to grow, they're going to be higher risk. And therefore, the financial system is going to be at higher risk. And therefore, I think economic growth is at higher risk. So this is actually pretty big stuff.
Yeah, one of the other elements that was part of the Moody's downgrade, at least in terms of the way they characterize it, was the weakness in the commercial real estate sector, Dick. And I know not all of these banks have any sort of outsized exposure to them. There are a few on here. But I'm curious as to how much of that becomes a factor in terms of risk assessment.
Well, it's a factor in specific banks. Like M&T, you mentioned at the outset. M&T has a large commercial portfolio of hotels and office buildings in New York City. Obviously, that's not the best place to be with that type of portfolio, but they've been working on that portfolio now for about a year and a half because the government has been pressuring them to reduce the size of their commercial real estate portfolio as part of the total loan portfolio. The other thing you have to think about is, I'll give you a simple example. A number of years ago, I was walking down Wall Street where I was working, and a lady walked by me with her baby carriage. I said, what the heck is going on? And I began to understand that all of these office buildings were being converted into condominiums. And therefore, if we have a housing shortage, and we have excess space in office buildings, the logic is that they're going to convert these office buildings into condominiums. I'm absolutely convinced that will happen. So, yes, there'll be losses taken. The losses will be big in some selected number of banks, but it won't be, I think, anywhere near the fear that's been raised for the industry as a whole, and it's certainly not a fear for the biggest banks because they learned a long time ago that commercial real estate is an iffy business.
I am curious. I mean, we had the 10 actual downgrades, and what was it, like 6 banks that are on review for downgrade, and then you had the remainder there, kind of on this negative watch. Are there any names on there, Dick, that you saw that maybe you don't think should be on there?
No, actually not. No, actually, in the list that they put out, they've got a couple of banks that we have sell recommendations on, like Capital One and Ally Bankshares. They've got a few banks that we have hold ratings on because I really do believe that the banking industry is not out of the crisis created by the increase in interest rates. I do believe, I disagree with your earlier guest in that I believe that the Fed will raise interest rates further, because I think the CPI could be higher in a couple of days. But I mean, the bottom line is, the banks have been losing market share consistently since Dodd-Frank. These new rules that put in place means that the banks will lose even further market share, and the banks have to restructure their business models. They are doing it, which is to their credit.
Yeah.
They understand it, they're doing it, but they have to do it.
Dick, always great to catch up with you, and I don't know if you've walked through the financial district as of late, but a lot more baby strollers and dogs down there than what used to be. Dick Beauvais there over at Odeon Capital. A look here at the downgrade over at Moody's. Stick with us. We'll be back. This is Bloomberg.
When you look at tourism, it's booming, but it also means some of the islands are overcrowded.
Exactly.
Is there something that you can do about that?
Thank you for asking this question, because I want to make sure that, in 5 years from now, we will not have sacrificed, the beauty of our and sort of natural environment at the interest of a very rapid growth. So that's why I'm really focusing on sustainable growth. That's why I will always push for quality over quantity. Very strict in terms of standards. We are actually looking at our local and regional sort of planning legislation across the country to make sure that we know exactly what we can build and where we can build it. There are parts of Greece which have reached saturation point, and if we have to place restrictions, we will, in order to protect, especially islands, which are more sensitive.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open. Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
All right, Broadridge Financial Solutions out with its latest earnings results. The shares up for a second day here, having its best day going back at least to May. Adjusted earnings per share beating estimates and a dividend raised by about 10%. The CEO of Broadridge, I'm pleased to say, joins us right now, Tim Goki. Tim, let's start off here with the numbers here. $3.21 on the adjusted EPS, $1.84 billion on revenue. Don't want to shortchange you by a few $billion there. But overall, this was a pretty solid quarter. There's still some questions here about the outlook going forward when it comes to growth. Where does that growth come from?
Yeah, thanks, Romaine. It is. It's great to be here. Always great to see you. And just for your viewers that don't know us as well, we're a $20 billion market cap global fintech, really focused on supporting the critical infrastructure that underlies corporate governance, investing, and communications. And so it was a good year for us. For the year, both recurring revenue, organic, up 9%. Earnings up 9% for the year, and we did a good guide for next year. And when you talk about the factors underlying that growth, Romaine, there are really two big trends that we're seeing, and that is, first of all, the continued democratization of investing. That's been a trend for a while, but that means more investors having access to more investments at lower costs. We saw the number of investor positions grow 9% in fiscal 23. And our forward testing is showing robust growth for the next 12 months. And then the other one is really digitization. And we just heard your prior guest talking about the banks needing to change their business models, needing to continue to evolve. We serve a lot of those financial institutions. We're continuing to see strong demand for for new solutions to digitize both their front and back office, as well as how they communicate with their clients through digital communications, which is another big growth area.
And Tim, I'm curious, you talk about the democratization of investing. And if we think back to the past 3 years, that's kind of been shorthand for retail investors, more of these self-directed types coming in and making their own investment choices. Is that what you're seeing at Broadridge?
Yeah, when you look at that number of positions that I talked about, that tends to be driven more by retail investing, and we're just seeing, even though the market's up now, but for most of the year the market was down, and despite that we saw this continued growth in positions, and if you drill into that, what you're seeing is continued real double-digit growth in managed accounts, which is about half of positions. And then the other, a little bit lower growth in self-directed accounts. So still a lot of strength there, really, as people continue to diversify their holdings.
I do want to ask you a little bit, Tim, about your role when it comes to proxies and corporate governance here. We kind of came through the last proxy season. There was a lot of talk here about all of the big investor proposals out there and kind of the trend as to whether they were being pushed through, whether companies were kind of front-running that in order to sort of deal with that before it even came to a vote here. How did that affect your business at all, if at all?
Yeah, thanks for that. I mean, because given our unique position, we can really see what is going on in corporate governance. And as you know, the main season for corporate elections was just ending, and there were some interesting developments there. So first of all, the number of shareholder proposals, it continued to grow. It was up 15% versus last year to just under 600. But very interestingly, the level of aggregate support, that's not necessarily how many won, but as you add up all the for votes across all those proposals, the aggregate level of support for all the proposals has declined quite a bit. So 2 years ago, it was 40%. Yeah. And the year that just finished, it was 25%. So you're seeing particularly lower support for ESG proposals. There's a little bit of, as you know, ESG backlash going on. Right. And so we have seen lower support for those proposals.
All right, Tim, I'm going to have to leave it there. Always great to talk to you. Tim Gokey there. He's the CEO over at Broadridge. Broadridge, one of the best performers in the S&P 500 here on this Tuesday afternoon on a day where, well, the broader market is really taking it hard off the lows of the day, but still red across the board. Concerns about what's going on in the world of rates, the world of banking, and, of course, right now with the global economy. Full coverage coming up right here on Bloomberg. Stick with us. We'll be back in a moment.
Everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO. I have a problem. I call you up. I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about like how long does it solve things, a lot of it starts with, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
This is Bloomberg.
This is Bloomberg Markets to Close, almost 2:30 here in New York. Let's get a check on what's going on in the commodities space. The commodities space under pressure. Abigail Doolittle standing by with our commodities close.
Indeed, but under a lot less pressure than it had been, Romaine. This chart is so interesting to me because this is a classic definition of a round trip. So overnight during the Asian session, the Bloomberg Commodity Index flat and then down, down, down. That weak China data a part of it. Also, the Bloomberg Dollar Index earlier had been down more than 0.6%. At that point, commodities overall down, I think, more than 1.5%, maybe closer to 2%. Now, down ever so slightly. Let's take a look at what's beneath the surface. At this point, we have oil higher. Earlier, it had been lower, up 1.2%, again, as the dollar comes off of those lows. Natural gas are still supply concerns driving natural gas higher, up 1.9%. But, Romaine, the dollar is still higher. I think at this point, up about 0.4%. You can see that that is really weighing on metals, copper, and silver, both. But a little bit of a comeback here for the commodity space on the day.
Yeah, that first chart you just showed actually surprised me here. An interesting rebound in the Bloomberg Commodity Index. So as you can see with copper and some of the other industrial metals, the damage still might actually be done. That has to do with China and its economic recovery taking another hit. The nation's trade plunging more than expected in July. Imports down 12.4% and exports having the worst decline going back to the start of the pandemic. Bloomberg Emerging Markets correspondent Sherry Hahn joining us right now to walk us through this here. And let's start off with the trade balance, imports, exports here. Imports were soft. I don't know which is more surprising, that exports were down so much or that imports are also down.
I would be a little bit more surprised with the imports number because we knew that global external demand remained weak and that really hurts China, right? So exports have been down, but imports falling 12.5%. We're talking about 12.4%, 5 consecutive months of declines. And that is the issue, right? We were expecting this recovery in consumption in China. It started to happen after the